Bears are pretty much scalping, but still the pullbacks are pretty deep. But right here, it's a very shallow and the bulls swing again. So that's because you are in a bull trend, and that's what you should be expecting from the bulls. Good morning, everyone. This is Rose. Today is Monday, June 2nd, 3 minutes after 9 a.m. All right, today is a free session and it is an all day long session. So if you guys want to stick around after I am done with my session around noon, Elle Brooks will join us with a couple of hours, and then Brad Wolff will come in and close the day for us. So please don't go anywhere. You can ask questions. Please use the GoToWebinar question box. If the question box is not open, wait until the presenter opens the box for you. You'll see it when the commenting is available. Submit your questions. You can submit your questions if you're using Discord, but we're not always looking at the Discord window. If we're not trading and there's time, we sure look at it and try to address some comments and questions. But the official submission of questions and comments is through the GoToWebinar. Okay, just wanted to clear that up. All right, so let's take a look at the price action from the higher time frames going down to the lower time frame. So what you have here is the S&P monthly chart, and you can see here we have been in a bull trend with pretty good decent pullbacks, but we are in a bull trend. So you can see bulls are swing trading and bears are pretty much scalping, but still the pullbacks are pretty deep. But right here, it's a very shallow and the bulls swing again. So that's because you are in a bull trend, and that's what you should be expecting from the bulls. On April 7th, market had a deep pullback to this trend line, and that trend line never, it is broken, but with a wick, not with a body. So the buyers immediately showed up, and I was really interested in this right here. So basically, I see we have a wedge here, other than a larger wedge, but here we have on this leg, you have impulsive leg, you have pullback, you have another impulse leg, you have pullback, and then you have the final third leg up, which is also divided into one pullback, two, okay? But I generally, when I'm looking at L's wedge structures, this is what I'm looking for. I don't care if this leg has two sub legs. To me, this is the third leg, and the third leg started here, second leg started here, and the first leg started here. So, so if I'm looking for a first pullback and then first sell and then first pullback, generally I like to sell as long as we don't take out that high. I'd like to start selling something like this. Okay, I would look for a second entry short, and then I would look for market to come down. Well, I lost my, it interferes with this tool that I'm using, so let me try again. So I'm looking for a second entry short after that first pullback, okay, and then take out that neckline and then pull back, and then it could be two legs, it could be generally three legs, but this is the target I'm looking for. But the actual target is actually like this. So I'm utilizing the first pullback and the second pullback. First pullback starting point and second pullback ending point, which happens to be the third leg in the wedge starting point. So what I'm doing here is exactly like that. Okay, so the first pullback, second leg, second pullback, and the third leg up. So when you connect these lows, okay, you have two targets. You have this projected target, and then you have this wedge pullback target. Okay, these are all targets. But notice what has happened there. Even though market came down and tagged the starting point of the third leg up in this wedge structure, it bounced and it did not close below that projected line, okay, measured from that correction starting point to this correction leg ending point. So that correction starting point to this correction ending point, you can see that is that magenta line that is kind of important. Even though the bear sold leg 1, pullback, leg 2, pullback is leg 3, maybe, however you count it, or leg 1, leg 2, it could still come down, but something happened here that the bulls prevented bear body closing below that line. So to me, on the monthly, this is still bullish. I still have a measured new target. Can the market be still long? Yeah, I think the bulls still see this as an always and long. We have tried to sell. We have 3 bear bars in this leg, but this pullback, perhaps because December 6th was the highest high, probably market thought of this as overbought conditions, is kind of being remedied. Okay, and if bears think that the market is still always long, we may not see those bears just yet. But what the bears see as this possible pullback, so they're looking for a lower high and sell and reach back to these lows once again. Okay, the goal is to now not just to come down here, but they really want to come down here and there. But they have to show us really strong bear bodies. Is again, this is a monthly chart, so is the last month close on its side with an upper wick. It seems that we'll see a bull pressure there, but it is not a good bar. So it is, some will consider this bar as a bad buy signal bar. Okay, is this April 7th bar month of April. So what they want is they want to actually sell and bring price down to here, perhaps down 33%, 50% down. But that means we have to see this month selling, starting with the first week, this week, and we need to see weekly bars closing on their lows to bring back price down to here. That would perhaps give us a official third leg down, but the third leg ends up becoming is some kind of shorter leg, a shallow pullback. Bulls can still show up. So I don't know what the bears will do if they're not all that confident and we don't see bars closing on their lows. That means bulls see always and long, and they want to get back up to the December 6th high. Maybe get a breakout from this broad bull channel, because that's what you get from the broad bull channels or bear channels. You get a breakout finally. So we have a really nice bullish pressure. Excuse me. And if market wants to keep pushing higher, they're going to have to give us another possibly a bullish month, get back to the December 6 high. What about getting a double top there and sell? Well, if the bears stop the market there and maybe give us a higher high, major trend reversal, that will be a fake breakout from this channel high. Or if they can get a grip and start selling, maybe give us a lower high trend reversal. I don't know. Right now, last month was pretty bullish. So let's take a look at the weekly weekly chart. So what I'm trying to say is that we're still bullish on the monthly. Is weekly, we had a really nice sell-off, which is doji right here you saw, and the legs coming down. We had that double top lower high from December 6th. Neckline was broken with a bear body, so the market kept selling into this trend lines. But notice how the trend lines is aligning. So you have the 20 bar EMA. I'm using the 20 bar EMA. That's 20 week EMA because the bars are weekly. Then you have the 50 SMA. Then you have the 100 SMA. You have the 150, and you have the 200 SMA. If you're interested in copying this chart template, you can go to brookstradingcourse.com and take a look at L's My Setup page. He has all of the indicators and what the settings are shared on there, and it's public information, so you can get it from there. But this is what I'm looking for, and right now it's aligned pretty much bullish. So this was a deep pullback, and the market could be trying to make its way up to these levels. But if you follow the weekend reports, we have Andrew writing our weekend and what to expect. Look forward, I call it a weekly look forward blog posts on the weekend. You can sign up for these emails, and you can get them from the brookstradingcourse.com. So according to his chart, he's got an inside bar. Well, I would still consider this as an inside bar, but traditionally it really isn't, because the legs, I'm sorry, the upper wicks are protruding outside of this outside bull bar. So to me, a perfect inside bar should be completely encapsulated by the outside bar, which we don't. But imagine this is an inside bar. I think on his chart, they look like inside bars. It could be a data provider issue, but bodies are inside this bull bar. So again, a similar things happening here. This time is for the bears, right? So bears actually sold, right? You have leg one, actually leg one, pull back leg two, pull back leg three. So you have this going on right here. So that means this is the first correction leg, second correction leg in the wedge structure. So that means when this reverses, you want to start with the first correction leg, connect the second correction leg ending point, first correction leg to the second correction leg ending point, okay? And when after the market makes its third leg down, look for a pullback. Don't buy it right away, because that probably is high one from the lows, and bears who sold here disappointed will sell above the first sell, okay? They probably sell at the high of this bull bar. It's going to come down here, okay? Because what it can do is, if it were to close a bear body here, this would not have been done. It could have continued to come down. Since the bears brought the market to where they got stuck, which is right there, and they could not close the bar, we finally start the high two, and bulls are buying above it. So this leg is completely done, and the bears actually break even and exit out of the market. Due to bears exiting out of the market, bulls are coming in pretty strong, and they're able to close strong bull bars. So what does that really mean? That means we're going to go right up to, we're going to go right up to that projected target line, that first correction leg starting point, second correction leg ending point. So expect a couple of legs up. It could be 2 legs, it could be 3 legs, but you buy into that. The actual target is there, but you buy into that, and if it's a pretty steep, pretty tight channel, chances are sellers waiting there. Most of the time you get some sellers. Let's see what we got. And you can see leg one, pull back leg two. As soon as bulls brought the market back to that projected target line, okay, so the second was right there, they start to take profit. Profit taking is very weak, okay? So it looks like they want the third leg up, okay? So here's your leg one, pull back leg two, pull back leg three. Once bulls taking some profit there, bears are not showing good looking sell signal bars. Nobody wants to sell against this bar. Even if they do, probably buyers waiting as early as above this bar or 50% of that bar. So that ends up becoming a pullback, a second correction. Oh, by the way, for a pullback, I can now actually measure my projected target. If bears start to sell, they could bring the market down to here. So it looks like we're on our third leg up. Is once we cross above this, so that week actually gapped up, right? And above started here, pulled back a little bit to the trend line. Bulls took profit and then continue and close higher. So that means they're going to get to that target. They already got to that target, got above it, pulled back, bounced again, but they couldn't close last week as high as the open of the prior week. What the bulls want, get back up to these levels. Can they do that? They formed a third leg up. I'm not sure. They could, okay? Is this week needs to start pretty strong. We're already somewhere down 58, 95, 94 area. So we're somewhere here. So if we open up closer to the close of last week, okay, and then we start to get bulls, we might start to go up. But the bears want now, they see leg up, pull back, leg up, shallow pullback, and then leg up. So what they want is sell into that area and possibly here. If the bears become pretty prominent starting this week, we could pull back here, but we could still find some buyers there. So I'm going to mark that as well. So far, this remember, the third leg generally gives us 2 legs. I always look for 2 sub legs. So if this is, say this is a no pullback below that bar. So this is kind of an implied pullback is okay after the second leg. This is an actual pullback, right? We went below that bar. Now we'll keep going. We're not moving underneath this bar, nor this bar, and then we continue to go up. So this is kind of like a separation of the leg. So this is the third leg. So in the third leg, imagine count like this. We go up, we come down, we go up, but they failed. So yesterday not closing above the prior week's open, it's kind of telling me we might have some kind of weakness here. Okay, could we become bearish? And I'm going to keep this trend line. Can we come back down to it and continue to sell? Maybe, but I'm also going to find here is up, down, up, down. I could use from there since pullback started there. Going to use that. So that right there is kind of important. We might actually pull in between those 2 trend lines is dueling, and then bounce from there rather than closing. Then here's what I would then do. Then this becomes the official leg, the second leg, and then that becomes the official pullback as we go below these bars. Then the official third leg can start. So I don't know what's going to happen here. Right now we're going sideways. There's some still bullish pressure. We could go up a little bit, trap the bulls, come down. If we come down here, I'm going to see if we can trap the bears around here at these dueling lines, and then see if we can actually start the official third leg up. It's a little bit complex. It's things happening here, but you know, it's not new to us, right? This happens. We're going sideways. This is sideways, and you can see since this is an inside bar, it's also some kind of a triangle. Inside bars could be formation of triangles on a smaller time frames. Therefore, it could be a flag right here, and you could see the flag actually form. So you have several types of flags, right? You have 3 types of flags, and the third one divided into 2 kinds. So you have the traditional flag, okay? Sometimes the channel can go all the way down and breach the pole, okay? If that's still a flag. You would look for a very prominent wedge bottom, higher low, and a breakout. So that would be the traditional. The second one, what I call is a bull flat. So I don't call it the bull flag, I call it the bull flat because the flag portion of it is very flat channel. I generally, if it's a bullish, I generally look for a W pattern, which is a double bottom pattern. And the bull's getting above the midpoint and then breaking out, pulling back again. Remember, this is a trading range. Trading ranges can fail every breakout. You can see there's a failed breakout to the downside, a failed breakout, and then goes up, right? And then that's how you break out. The third one has 2 types, right? So you have spike, pullback, and channel up, right? Something like this, which I call this unsustainable breakout. You always get this 3 pushes, 1, 2, and 3. This is 3A. And then I mark that, I'll always calls it that spike pullback channel. But if you listen to free videos and somebody else on YouTube, it's always called spike and channel. That is a mistake. That is a missing information right there. It's never spike and channel. It's spike, pullback, and channel. That pullback is super important, okay? So say this is actually the spike, this is actually the pullback, right? So right now we're moving up. Did we make 3 pushes? Maybe. Eventually we will pull back to that pullback area, okay, with several legs. Then you look for a double bottom and then reversal back high. If that reversal fails and gives you a lower high, then we break this and you have a measured move of this channel down. So what you do is you look for a pullback, either the high of the pullback bar, generally they're bare bodies, or all the way down, and you look for a double bottom. Then you look for a test of the highs and breakout. The B, 3B, is basically this. Either it is a expanding triangle flag, okay? Eventually we come down here, okay? And then we break out, or it's contracting. So what we have here is possibly, it started as an expanding, and then it could be contracting. So it is basically a triangle. So triangle, so looks like it wants to break out to the upside, but it's gonna want to come down, maybe trap everybody, and then go back up. What it looks like right now, it's trapping. The bulls try to come down, but they are above the apex of the triangle. So if we start here today, move underneath that apex of the triangle, come down to this trend line, and you're selling, you could get trapped, and it could reverse back up and keep going higher for the rest of the week. So I think the bulls want to continue up, but they need to trap the bears. Now, it could continue to come down. So say we come all the way down to these levels, right, and touch here, and then reverse back to the apex, get above it, and then go up. Again, this area, I'm going to be paying extra attention to this area, okay? So we'll see how this goes, but I think market is trying to reach here. Now, there's something else there that is an interest to me. There is a tight trading range. So I'm going to find that area. That area is attracting the market. Tight trading ranges, right, is especially the 50%. If we're coming from underneath, that will be used as a resistance, okay? Eventually, we're going to go up there, and the bears will try to sell it twice. We're going to go up here. They're going to try to sell. We're going to go up here. If they succeed, that will be a major swing reversal back down, swing short. Again, these trend lines are going to be important. Perhaps if they break below it, then we become very bearish, and we could come down even to this area. I don't know yet. This is still very bullish. So I'm going to try to find the level. That's the trading range, right? So this is the trading range. I don't like trading ranges that are wide. So I'm trying to find the heart of that trading range. So somewhere here, we could go in and test and get 2 rejections, and the market could try to sell. If the selling fails, okay, and then we get above, we start to close bull bars above it, we're going to get above the December 6th and make a new high, then we could start to come down. So what market wants to do, probably get above like this, okay, and then eventually reverse back down. That would become the 3rd leg with 2 sub legs. Then we could come down to here. If they break here, pull back, they're going to come all the way down to here. I don't know yet. This is, again, weekly. Each bar is a weekly bar, but I'm going to mark it there. It's a tight trading range. It's the heart of the range, larger range, okay? So we might need to pull into that area. So to me, that is an area of interest. We have about 3 minutes. I'm going to go through quickly the daily, okay? Daily, we're sideways. We have a lower high with some kind of a neckline. 20 EMA is acting as support. This is still always in long. Friday actually closed inside this outside, inside. It tried to sell, and look what happened here. Bears were selling here and trapped. They ended up selling what I call is a mother bar, which is the outside bar, followed by an inside bar. Bears sold again, brought the market, look where they sold. They sold at close. They brought it down and got a break even, but failed. And then Friday goes and closes up here. That is something significant. That means bulls want to show pressure to get back up to this midpoint of this bar and then actually reach up here and get a breakout. What they want is these and these and possibly these targets. This is daily, so each bar is day long. It's not going to be that easy to get up there. Today needs to close above here to become bullish. Then for tomorrow, that becomes a buy signal bar. If that's what they want, I'm targeting this high. Okay, so I marked there that thick gold line, but first we need to get above the dash line with a bull close to continue Tuesday, Wednesday, Thursday into these levels. If today ends up closing below again here with a bear body, I'm going to target this low once again and this gap area. If the bears continue to close these gaps, we're going to come down and try to close this gap right here. And that would makes us very bearish as long as where today's body closes, okay? For bulls, I want to see a close above here. For bears, if we close down here because we're going sideways, okay? If we become bearish, then I'm going to target these gap areas for the rest of the week, all right? All right, so because with sideways, it's not all that easy. On the Globex I have some levels. We have found support yesterday, which is Friday, and we bounced from there, so that was a buy for me. And we went and closed. We tested that resistance and then the after hours into Sunday and London session. We sold. So bears want to sell and test these lows. Generally, what happens? If London session makes a low, U.S. session, if it cannot break out from the Globex side and starts to close this level, we could actually come down and test this area. Generally, it likes to test. If there's a significant selling or buying at the London session, they would want to test the high and the low. So is this a significant selling? I don't know. Right now, we're closer to the Globex high than the Globex low. So it looks like market wants to get to the Asia high and get a breakout, possibly test this area. I have a tight trading range, so it is acting as magnet, okay? Tight trading ranges are balanced zones. Market likes to go there, even if it breaks out, breaks down, until it gets a true breakout. And you can see here, we have been oscillating. They try to get a breakout, trapped, sold, look, even sold here, went back up, break even, sells again. So it's trying to get back there. Bulls want to close above it and get back probably into these levels. They might. I have some bullish targets marked, okay? We might, but what if they sell? I don't know. 90% of the time, we get breakouts from the Globex range every day. It is rare that we don't. That ends up becoming a doji bar on the daily chart. So right now we're closer, so the higher probability of reaching the Globex high, as you can see. But again, we're below this balance zone. Balance zones are market magnets. Now, if we go there, pull back, and then we start to break out, I'm going to use it as support, and I'm going to go long into that resistance. If we go there and we fail and we start to close, this is a key level, okay? If we start to close below the key level at bear bodies, then I'm going to target this low and see if we can get a breakout from the downside. So far, it's trying to get to the Globex high, okay? Hourly chart is, this is RTH, so you're only looking at the US session. Each session we have 7 bars, 1, 2, 3, 4, 5, 6, 7, and then 1, 2, 3, 4, 5, 6, 7. So last week was a short week. A Monday was half day, it's not included. So you have Tuesday, Wednesday, Thursday, Friday. I take last week's range. We are stuck in that range, right smack in the middle of it. Bulls want to mark up the prices and get to the higher portion of the upper range. Bears want to trap and sell. So we do have a wedge bull flag. So that means bulls are not only trying to get there, but they're also trying to get to that high. But we need to see strong bull bars. 3 bull bars, that's sideways and up expected on the hourly. However, I don't know what they're going to do. So they're going to have to start closing bull bars above that level, then get to that green line. Okay, so that green line is the target, interim target for me. Okay, this one's a target, that one's a target, and that's definitely the target. If we start to break out, that means we're going to go, bulls want to go and test that high. This is a flag. but the flag within a trading range that is huge, and you could get failures, okay, starting at the midpoint, middle of the range. So right now, bulls are trying to reach up to that and that, okay? But if it starts to fail, we're going to come back down and test last week's range low. So far, so good for bulls. Let's see how this looks like on the 5-minute chart. Here is bar one, okay? This is the close of Friday. This is the high of Friday. These are all magnets. Bulls are trying to go and test the close of yesterday. They want to close above that bar right there. If they do, we become bullish. That means we're going to try to test these wick areas. Sellers might be at these wick levels, but we'll see. First, we need to close above right there. Look like we are breaking from above the Globex range with the very first bar. I'm looking for this 15-minute bar to close so I can measure my 15-minute range, breakout range, and see how we handle that. It is a pretty large bar here. Bulls want to go and test that double top right there and the high of yesterday. This is low of yesterday. And take that. Bar one. All right. Bar one closed pretty bullish here. Bulls want to continue news items. Let's take a look at the news schedule real quickly, because it will give you volatility. You have PMI manufacturing. What time is it now? Okay, in 10 minutes, 9:45 a.m. Eastern time. ISM is the big deal. ISM manufacturing, that could make us bullish or bearish, okay, very quickly. Major volatility. It's already more than 10 points, about 10 points. So your regular scalp size is 10 points on 5-minute chart, and your minimum swing should be 20 points. So you could see, and then it comes to construction spending, but it's not a red label item. So 9:45, 10, big deal. Then you have Fed members around 10:15, and then Austin Goolsbee. Goolsbee is a right hand to Powell, so he can make big waves, big moves. So watch out. That's right around during L session. So we'll see some volatility during L session midday probably. So 10 minutes and around 10 o'clock, pay attention to the volatility. All right, so we closed the bar. That was Friday's open. Here is weekly open and daily open. Okay, so week started month. This is weekly, monthly, and daily open all in a nice package, like that. So is important level. Okay. Always market. So is weekly, monthly, and daily open. We have not closed above the magnet. Is Friday's close. Bulls want to get above it. Then the high of yesterday is not so far away. But let's see. You do have a wedge bottom here. Is up on this, down on this, up on this, down. It came down. So think of this as a final leg. Okay. It's a big bar. Would you buy above this bar one? If you do, bulls already start to buy to close of bar one. So I'm sure there are buyers there. It's very close to the magnet. That's because bulls want to close above it. But your stop is somewhere low, not just underneath bar one, but probably lower. Okay. So you want to see another bull bar here. I think we're going to end up going up to these wick areas. So 59, 27, 59, 25 to 27 area is where market is trying to go. Okay. So here you go. Buyers at the close of bar one, buyers above bar one. They're marking this up and trying to go higher. Target is 59.25 to 27.28 area. Could go higher towards the 59.31 area. Okay, that is the high of, closer to high of yesterday. I don't know yet. We need one more bar, is especially closing above bar one since they started to buy above it. So this is high one right here. You never buy the high one. Sellers are there because sellers sold here, disappointed. They will sell. The first is, you know, maybe this is high one and then we made high. So I would recount here. Then this would become high two and this would become high three. Since we made a low, I would count this as high one. That's why we're struggling here. Okay, so if we do come down, then the bulls will look for a high two. But that's if the bar two does not close bullish. Now, buying above bar one is, yes, they're buying, but it can become a little bit difficult due to how close you are to a magnet. Sometimes you get strong bears here. Their main goal is to not to allow bulls close a bull bar above it. So that's why we're struggling there with bar two. Okay. Plus, it's very close to the news, but I'm sure this isn't a good place to sell. A better place to sell is up here. So I think bulls will try to push this higher. So scalp target around 59.20, and then next scalp will be 29.25, and then bulls will try to push probably higher. So here is the bar two. Okay, opened. Actually, it's a good open. It's open above bar one closed and closed higher, so that's good, but the location is really bad, and this is why I'm hesitating to buy. Is bar one and bar two, good looking bull bars, but you are in a middle of a trading range. Okay, bears were selling underneath bar 79, trapped, and then sold again. I mean, they made money. They're got to be exited out of the market. So I don't buy, I don't care if the bar is great, because if I buy it right before the confirmation of closing above close of yesterday, I have a big risk. Okay, and you're buying smack in the middle of some kind of a trading range or a leg. So it can reverse, but bulls did buy. So now they might be giving bears a chance to come back down to these low one more time. See if they can actually allow these bears exit around there and then close the bar as high as possible, as weak as possible, to find new buyers and then finally get to these target areas. What if it sells? What if we close below where the bears actually sold right there and trapped? If we close a bear body, they're going to come down. Probably the 50% of the buyers will start to show up there again. We're very close to the news. Is I always have a rule. I might call the targets, but if I'm closer to some magnet, if I'm closer to some kind of a news event, I don't buy and sell. If the good looking bars are smack in the middle of some kind of a trading range, I don't buy. I don't do anything. They have their targets. They're struggling. These bulls, they both the close of one, they both one tick above bar one. They closed the bull bar above close of yesterday and they are trailed. So they found sellers there. So what will they do? They will buy again. They will probably try to start to buy somewhere around the midpoint of bar one. But that becomes, hey, let's buy here and let's figure out the break even. So they're going to want to get back to the first time they bought. That would be the close of bar one. Okay, so suddenly come in here and then we go right back up. That is the first attempt to break even around the bar one close. And that's what they're doing. So what I'm trying to say is that the limit order buyers are not so far away, somewhere around the 33% pullback and 50% pullback of bar one body range. Am I far behind? What's going on, guys? I'm looking at my trading view data. I'm not far behind. Seems to be I'm okay. If my data lags, and you guys see something that does not match what you have, do let me know. It's rare that it happens, but it can happen. We don't have lagging, so you shouldn't. I'm looking at the window. We shouldn't have. Do we have lagging? I don't know. If there's any lagging, that should be like a couple of seconds. All right, so look what happened with the bar 3. Bar 3 actually reached the bar 1 close where the bulls originally bought the close of bar 1, and that is break even for them. Now, where will the body close? If it closes above bar 1 close, that means bulls will want to bar 1 high where they bought for the second time. That'll be a full break even, and in that process, they can finally close above the close of yesterday. So that dashed black line, and you can see bulls bought the pullback. So the limit order, stop order buyers already entered. They're not happy. Limit order buyers entered, but all they're looking for, hey, let's just break even, see where we can close. Other buyers are stepped aside. They're waiting on the sides to see if the limit buyers will start to buy. When the both buyers enter the market strong and you start to get the bull bars, that's when other bulls will enter and you get more bull bars stacking up. So right now they're looking to see if the limit order buyers are making money. It's kind of a upsetting close is with bar 3. Should have closed above the bar 1 close. So now bears will try to sell probably, but this is the news release just came out in 9:45. So I could see limit break even with the bar 1 close happen, but bulls could not close that bar. Weak bearish, should have closed way above its midpoint, bar 3, because it didn't close above its midpoint. So now bears trying to sell it and trying to get another leg down or resume the selling. So everybody's looking at this bar 4, where will it close? If the bears fail to close it bearish and suddenly this bar, it's still got a 4-minute and 12 seconds. If it towards the end of the bar's longevity, it closes on its side, then the bears will exit and the bulls will start to come in. So it's still, you see, this is why I don't do anything. If it's right before news, right around the magnet, they can drill you. They can stop you in your tracks and you'd be losing what you bought. Bulls were targeting up 59.20 area, starting from 59.19 to 59.20, 21. But they're not doing all that great. But they will try to get there. They're now selling with a second small leg. So think of this as a leg 1. Pause. Now this is leg 2. That lower wick is basically a pause in a, before the second leg, counter leg here. So that also gives you a like up on this, down on this, up, down, down. So it's basically giving you a micro wedge bottom, possible bull flag formation. So what the bulls want still, oh, I can't really, okay, never mind. What the bulls want, they want to buy. We're testing the 50% of bar 1. What about the bears? Would they be seeing a bear flag here? Yes. They see a double top and they see a bear flag, but the problem here is the bar 1. Bulls bought. Some of the bulls got a chance to break even where they bought, but they couldn't close a bull bar above to go higher. So now other bulls did not enter the market. They did not see. Remember, I said bar 3 needs to close the body above the close of 1 to go higher, at least a little bit. That did not happen. So bulls tried once to get above the magnet, failed. Bulls tried twice, get above the magnet, failed. So now we're coming down with several legs. Could be forming a wedge bottom bull flag right here, but they need to stop this bar closing below higher time frame moving average. So we are at the 50% of the strong bull bar. If there are any buyers here, they have to show up here. Could come down 33% of its range, which is the lower range of bar 1. Still, you would get some buyers. But when do we become very bullish? Bearish. You don't want to see open of the day, open of the week, open of the month actually broken with a bear body, meaning if we start to close bear bars below that gold line, it's going to become bearish, and then we're going to end up coming down to this tight trading range area. We are at this tight trading range area, so there are some kind of buyers here. They could try to stop the bears here, and this is an ideal place. But bears see a bear flag, but it's a very strong bull bar, so I don't know how successful these bears are going to be. So bulls are stuck even more above bar 1 that they did not get a break even. They might start to buy the steeper pullback, but they have to get a really long lower wick below this bar 4. There's a 10 o'clock news also. So I'm not doing anything. I'm not taking any trades at the moment. So on the 15-minute bar, we have an opening range, which is this bar right here. Okay. Let me put, where's that? So this is your opening range. 15 minutes anyhow. ISM manufacturing is coming. I don't take a trade with that. Because if the bears get a breakdown of this 15-minute bar, that will be a Globex bull breakout. So what happens to all these targets? Well, bulls are trapped. They're going to want to get back up there eventually. They will get back up there eventually. But you can see this gap is now being by the bulls, by the bears violated. But I'm sure bulls are here underneath bar 1. And what they want is they want to now buy here. If you measure, if you are a bull and you bought above bar 1, okay, I didn't buy it because of the warnings that I gave you guys. They were there, they bought it. So now they're buying at the lower third of bar 1, and they want to get back up to their new average break even. Not the actual break even is up here. But this is the average break even. But we're getting very close to the news. We have still 9 minutes. Bulls are trying to prevent bear body closing below the open and low, because if they get that, bears are going to continue to sell, maybe until all the way down to here, and then the bulls will start to buy here. So they're already breaching that. There's no bull bar, so I don't know where they're buying yet. So you're going to have to remeasure. Maybe you need to wait longer, and then you need to look for bull bars. So this is now coming down. So that means you have maybe leg 1 pullback. Maybe the whole thing is leg 2 pullback. This is the leg 3. So it's coming down to here. You could have sold perhaps underneath this, but again, the chance of bulls showing up here was pretty strong. But now they're selling, but again, these bulls are stuck, so they will try to buy and bring it back up to these levels again. What about the bears? They're looking for a measured move target. So their measured move is down here. That's going to be a scalp. The first buyers will show up there to bring it back up. So then you have to, if you're still stuck up here, you're going to have to measure from here and find your average break even. Or you're going to have to wait for the bar to close bearish somewhere near, continue to sell into these areas. Then that would be the measured move, and then you buy into it to break even. Like I said, buyers were there. Yep, their goal was to get up to these wicks, maybe the high of yesterday, but completely failed. So I didn't buy that. I don't like to buy at near the magnets. I see a magnet breach, but where is the follow-through bar? It's not there. So I know that someone's going to get trapped there. If I were to buy and get trapped, I would have bought right away. I would have measured this bar right here. Remember, I said the 33%, the 50% they're going to buy. That is 33% right there. So what they've done here, I see a bar like that, okay? If I'm stuck above it, say I bought the close of it, I said they're gonna buy. They bought right there, and immediately, maybe they bought there, maybe they bought here. That's the one they bought. So 33% would be your first buy order. That would be first break even. And they actually reached the close of the bar. So right there, I know these bulls are not in there, and I'm happy that I did not enter this trade. So now what? There is a breakout. Say the SPAR closes like this, there will be follow through. Okay, so we're there. That's a scalp. Some bears will take some scalp there. We are reaching this tight trading range area and a breakout. Some bulls are there. They start to scale in. I don't like the scaling with bear bars still printing. You have to wait. But this is your measured move. It can continue to come down. In fact, we opened up at the moving average, and what seems like is bullish, but it went sideways and reversed back down. So bears are looking to bring this down further. Bulls are stuck again. We're probably going to pull back to these moving averages because they need to fix, like I said, even though they might be buying here into a scalp, but the measured move target is down there, so we might need to get there before any buyers would show up. So if you see a bounce here, trying to get back to the bar one, that's because bulls are also measuring about 20 points from bar three and buying about 20 points from bar three and buying, scaling in, try to break even. So you can see they're finding some buyers here, but that really is a profit taking. It could still sell. So I wouldn't really jump in thinking I could buy this because bears see more targets to the downside. Is this always in short? Bulls try to get an always in long, failed. So yes, ended up becoming, instead of a bull flag, ended up becoming a bear flag. So 50% of the time, if market is going one way at the open, could be wrong. That's why you don't want to take a quick trade just because it looks really nice. Look around and see where you are, okay, at the open. Are you at a moving average? Do you want to buy at the moving average, even though bar is nice and they bought above it and they could have gone up? It didn't. Even though they closed bar two above the moving average and above, so everything looks really good for the bulls. They could have easily get up here. So what happened there? It could be institutional sell. It could be something else. It was so close to the news hour. So they trapped you. So what do? You go into a survival mode, which is, how do I break even with this? Where are these guys going? There's a leg here. It was pretty strong. They bought already there and failed. So maybe I shouldn't buy anything until I see the next breakout point. 1, 2, 3, 4 bull bars and a bull flag, and then gets a second leg and a third leg up. So I think this is a better buy zone for bulls than buying up here. So I said there's scalping here. What seems like a bounce may not be all that great of a buy because it's nothing but a profit taking, and it can continue to come down. If bears close the body of one, okay, so let's mark this. All right. This is bar 6. Wait, I don't need that. This is bar 6. If bar 6 closes below that is scalp area, then it's going to come down to here. So you want to see that body is ISM manufacturing is coming up in 50 seconds. So bears could quickly come down to here. There we go. Careful. Buying and selling is, that's bar 6 close. Bar 6 did not close where I wanted to close, but since this is news and we have a measured move target, bears want to take that measured move target. So let's see if we can get that, but you are at the tight trading range. They also want to trap the bear selling, but target is target, so I gotta have to wait for that target to meet. I'm going to take profit there. I finally sold. I didn't sell underneath this bar because I wanted to see if there are any buyers. This bar closed, so I sold. I sold closer to the bar 1 hot low pullback area. So I took a little bit of profit there and I left the runner. So I'm taking profit right here. Could come down more. There's a gap area. We could come down a little bit more. Maybe like halfway down. That'll be a 1.5 R. Right now they're taking profit. It's overreaching because ATR is so large instead of bouncing, but that's profit taken. Coming down, going up. I've already taken my profit there. So I entered a little bit late, entered here, entered a little bit higher, and quick scalp there, took profit there. It's probably wants to come down to here. We're getting closer to the low of yesterday. Obviously, market proved that it's not going to go up to the high of yesterday. So now, if it's not going to go there, well, it's going to go somewhere else. It tried to go sideways, but nope, bars are closing strong. We're now taking out a very strong bull bar, open and low. That's measured move possibility, which we got it. So now bears trying to see if they can actually mark this down all the way to the low of yesterday. But because ATR is so high, you gotta have to take profit where you need to take profit. You cannot assume it's going to keep selling. First, it needs to take profit before selling. So that's why I took profit. I don't care about that wick. Could have come down more, and it could. This bar in 2 minutes and 28 seconds could close below the 1 R or the measured move and continue to come down, extended half R. And that's where it seems like it wants to go. This is where you can leave a runner to run into here, okay, and here, and obviously to the magnet nearby, okay. Problem here is this gap area. There are a lot of buyers were there, and buyers ended up getting this swing up. So that's why if your target is somewhere closer to that buy zone or the gap area, it's better to take profit and not let this go against you. You can always leave a runner, maybe a 1 contract, measure, manage the risk, because if the body does not close below this level, we're never going to come down here or there or there. But if the body closes there, then your runner will make money. You can even add another contract. So I'd be careful there. I've already taken my profit, so I'm not going to risk it because it's also news. Now, you don't have to pay attention to news, obviously. The only time you pay attention is, when the news is going to be released. It can make things, price action go faster, which is good, which is what you want, right? You want to reach your targets faster. But if your targets are not solid and you're in the wrong direction, you're also going to be losing faster. So if you're not, I'm streaming, so I can't take large risk. I'm trading on a different chart and reading from another different chart. It makes my attention divide. So I take quicker profits at my target level. So measured move from this was that. Now, what about the bulls? Are they still stuck here? Yes, we are now in a trading range. We're at the bottom of a trading, not really the bottom, but the lower third. Because if you measure this as your trading range, okay, so let me get rid of this for a minute. Okay, Look where we are. If you extend this, we're actually in the buy zone. I mean, this trading range is actually a little bit higher. So I'll take that and I'll take this. Okay. So if I apply L's concept of, okay, dividing a large trading range, high, low, into 3 sections, where are we? We are in a buy zone. So this is a sell zone, upper third. This is a buy zone. Okay. So there could be buyers here, and we just tested the midpoint, okay, of the buy zone. So they are scalping, these bears are scalping and taking profit there. No, that was, I didn't trade before news. I waited for news, and then I saw, once I see it, news is going to make things go faster into my targets. Once I see confirmation which way it's going, look at bar 5. Closed pretty strong, right? So I sold. Now bar 7, I've already taken profit. I'm not in this trade anymore. So that was my quick sell and take profit with confirmation. This is the one that I did not want to do anything, because 50% of the time at the open, you're probably in the wrong direction going. And even though the bar 1, I said they're going to buy above it, buy to close, they want to get up here. I don't have a confirmation that the bulls are closing above a close of yesterday magnet. I want to see 2 consecutive bull bars. I only see 1 bar, which is bar 2. And then the bar 3, right there, that was your very first sign bulls were in total trouble. That close should have been above that level. If it was above that level, that would have been a pullback and a second leg up, third leg up. But that didn't happen. So market will give you a chance to enter and break even quickly before it drops down. And that's what happened there. So if I were to buy it, which I didn't, because it was also 9:45 a.m. news, so I didn't want to buy it, bulls immediately had their break even and exited. If they didn't exit, say they break even and didn't exit, and this bar 1, 2, 3, 4 closes like that, you have to exit, because it's gonna, now you have measured move from here for 1, that's 2 here. Originally you would measure like this, right? 1, 2, 3, 4. I'm missing something there. So they got a 4R, or if you have more breakouts, then you would look for a measured move, that. And that is the measured move. That's where the bulls are now buying. If you are a bull and stuck above that bar 1 and you buy here, where's your break even? Right there. So bulls are now desperately trying to get to their break even target. I said they would buy around. Did the bears actually close below the measured move target, a bear body? No. Look, first time they tried it and the second time is not. That's because bulls are buying into the profit taking. That's why I took profit. It's now going up to the break even, average break even. This is dollar cost average for bulls who are stuck above bar 1. So let me do that, right? So that's their, let's see if they can actually get that 96. 58, 96 is what they want. Now, bulls like me, okay, if you were a bear and you sold and you took profit at the measured move, that's fine. Now you can buy into it, okay? If your runner is not running because you didn't see any bars closing below it, you exit out and then you buy, you reverse it. You scalp a little bit at the high. If you have multiple bear bodies, it's a tight bear channel, probably bears are above this bar or the close, the open of bar 6, somewhere there. They know bulls are desperate and going up there. Those bulls buying here are not desperate. Those bulls buying here taking profit above the strong bear body. This is not a good bull signal bar. This is not a good buy signal bar. Even if we go up here, that's because of these bulls above bar 1 in desperado mode. They want to get up here, take their break even, and then the bears can sell and bring it back to the bar 7 high. When you get bad looking buy signal bars, they become magnets that we come back and retest them. The only time we reverse back up and go long, say we go up and then it comes back down, but it does not test the high and leaves a small gap, then you can see bulls coming in strong. That's where these bears still were selling for more targets, get a break even, and then exit out of the market, and then you start to get bull bars. So right now, bulls haven't reached their average break even, and this is why their market is stalling here, because other bulls exploiting this, they know the bulls are stuck up here, trying to get up here. They know if they can buy at the profit taking, they have to take profit somewhere up there. So they're scalping. That's why we're stalling here. Bulls want to get up to this level. They might get there because they kind of earned it. They got a good looking bull bar. The only thing that going against them is bar 7. Not a good looking bull bar. It's actually closed below its, nearly below its, below its midpoint. That makes it a stronger bear bar. So they know if they buy this body, okay, they're not going to be, if they buy the close, they buy one tick above, limit buyers already bought, okay, at the 1R or the measured move of this move down. Stop order bulls either buy with the market, they may or may not bought it, but the actual stop order bulls are sitting up there. And when they start to buy, their measured move, their break even is going to be calculated like this. Then this is where they want market to go to. Right now, those who bought down here and trying to get a break even, okay, haven't really taken anything. So anybody who bought there, they still need to get to here. 90, was it 96? It was 96 or 97. I could be off there a little bit. 97. So this and that is the targets for bulls. All right, bulls that are scalping above bar 7, getting out. Others are still holding. They're probably trying to get up to this level. So 96 to 97 area. It's very difficult because you're buying against a very tight bear channel here that bears want to sell. But the bulls got a really decent bar here, and they're trying to close another bull bar because they're in desperation mode and they want, we got to get there no matter what. Bears can sell all they want at the breakout test. Bar 1 and bar 5, that's a breakout test. So they know bears are around here starting from above bar 7 high. Bulls bought there, scalped a little bit. They're hoping that they can bring market up to here. So you don't really trade with hope. So if you're in a situation buying against a tight bull channel, maybe minimize your losses, buy at the profit taking measured move target, which is right there, and then take some profit right there. Maybe leave a runner. If the bar closes, another bull bar closes, then add back another contract or two and target your average break even. So is the reason why we're stalling is not random. It's for a reason, but they're still trying. Right now, the bar 9 is forming, it's printing, and there is 45 seconds left. So if you take a look at your chart, that's how we'll know the delay. Normally, I have a toolbar clock right here, but my Ninja is still problematic. I couldn't fix it over the weekend, so I need help from the Ninja support team. But I'll keep calling. So this is bar 9 and 15 seconds left to close this bar. 12 seconds, 11, 10, 9, 8, 7. So can you see? You can see how we're stalling. These bulls are still taking profit, but we now have a second bull bar. So that means bulls now want probably continuation, not the fantastic looking bull bar, okay, bar 9, but still continuation and it's kind of like minor, how do I call this? So it's a leg up pullback. Okay, we're still in the pullback phase of this bull, really bad bull leg. Bears don't want to allow bulls reach up there, and they want to come back down to the bottom of the tight bear channel. Bulls are like, nope, you already got your target. Is you move the market down, you turn the market against us when we have every right to go up to our very first target. You turn the market around. So you took your profit. It is our time to at least break even. Now that's the story, obviously, but if you should be a pattern trader, and what does a tight bear channel do? That's your pattern. It's going to try to prevent bulls from getting legs up. Okay, so right now you're in the pullback phase of this bull leg that already started terribly with bar 7. So, but it's still, first leg needs a second leg. So I just have to give a little bit of room for bulls to at least try to get to the first break-even target, which is right there. And that's if you measure from the measured move. Other bulls are looking for the very first bull bar to buy, that was bar 8. So if they measure from the close of the high, then this is their break-even. And that's why these two price points become the magnet for bulls. If you have issues, please post underneath support. Our site admins monitoring issues are there. There's nothing I could do with the lagging. All I want to know is that this is bar 10, right? 7, 8, 9, 10. Are you guys are seeing bar 10 forming? Or do you have bar 11 forming? As long as the bars are the same on the chart, mine and yours, you're gonna get a couple of seconds. I don't know. It shouldn't be no more than 3 to 5 seconds. But if there's more lagging, then definitely post underneath support. I don't know exactly what the regular lagging is, but it shouldn't be too much. All right, so we have an outside bar followed by an inside bar. Bulls are looking for a breakout from the bar 8 high. If bar 10 body closes above bar 8 high, they're going to reach higher. Bears want to double top with bar 6 high, so we might actually go and test the bar 6 high. So you can see how bulls are still pushing this. You have the Fed member is speaking also at the moment. Bulls are trying to get a breakout with this bar. There you go. They're about to claim their average break even by buying the measured move target for bears, and that is their earliest exit is right there with average dollar cost average break even. They're trying to get back to the open of the week, open of the day, open of the month, which is bar 1 open. Still not bullish. When you're buying against, against a tight bear channel, when you're buying into a desperation mode, you're already scalped above bar 7. Okay, you are just basically saying, hey, listen, if bulls are strong enough to get to their average break even, that's great, I'll make money. But you already made money and you don't care, right? So this is obviously very bearish, and bears are looking for a double top with bar 6. So what you could have done, you could have also taken profit at the bar 6 and not worry about actual break even. So 3 bull bars, all 3, there's something fundamental happening for bulls that's actually good. Look at the bar 8 close, look at the bar 9 open and close, look at the bar 10 open and close. 10 is not all that great, but still it's showing some kind of momentum for bulls. But if you are a bull, you're stuck here and the market went this much against you, okay, what are you going to do? Are you going to sit there and wait for these targets to meet? What you're going to do is, as price gets to that target and you see that double top, possible double top, you're going to take profit because it could have closed bearish. It didn't. So fundamentally, this is actually pretty good for bulls, so they're still showing us some kind of resistance or resilience. That's the word I'm looking for. So that means they really want their first dollar cost average. I thought it was 96. Somehow ended up becoming 97. I don't know. Is it because I measured from the bar one close? I don't know. So if I were stuck, I would have taken profit. I wouldn't wait for this because if you're in with one contract, you enter with one, that's your target. I see something like this and I'm in desperation mode, I will double my contract that is stuck here. All right, so the bulls got their first break even. Good job. They got it because they showed us momentum here, and that's the second leg up. They could also reach right there because that's measured from, if you're stuck with the stop order there, you buy the first good looking bull bar, which is bar 8 high, then this is, hold on, this, I know I could do this, send back. That, well, you don't really need it, I'll just get rid of it. This is your break even. But you should have been already taking your profit average. Now you can leave a runner, see if the bar closes bullish, then they will keep pushing higher first here, and then there you go, there you go, there you go. And that right there is L's 80% probability of how to break even with, how to scale in and break even with good looking bull bars. Now, I want to show you guys something so you can go and watch. It's free. If you don't have the course, then please sign up for the course. It's $399. It's actually $499 if you are also want to learn how to trade the Forex, which is the combo. It's the best value. Get that one. But regardless, you go to the Brooks trading course, okay? So there's several areas where you're going to learn, where is that? Managing losses. This is a fantastic how to manage your losses. But really, I'm more interested in, where is that? Measured moves, learn about the measured moves and how to reverse into that measured move if you're stuck. I'm looking for, that's not the one here. This is the one. Is swing trading, scalp trading, right? This is very important. And then if you go to scaling in, this is the one I want to show you. Actual risk, protective stops, initial risk versus actual risk, how to scale in and fix it. Now, this is a lot more elaborate because that goes into, okay, managing losses, which is where you learn truly how to fix, trades. But if you don't have and you want to sample, go to the Brooks trading course. You don't have to log in, but it's better if you log in. Go here and type London. Okay, and hit enter. And the very first blog post, London Price Action Symposium, that our friend Tom Hugard hosted with major names, including Al Brooks. Here you go. Major traders, very advanced traders. So here's Al's presentation. Watch this presentation from the beginning. Somewhere around here, Al explains if it goes against you, you're in a trading range, where to buy. It was the lower third, which I showed you. You could start to scale in. Or you could start to scale in with strong bull bars like this and expect an 80% probability where you measure where you got stuck to where you enter, and then a 60% probability could get you back to where you got stuck originally. Now, your goal is to get the 80% probability, and if the bars continue to close, then you hold a runner and go back to exactly where you got stuck, which is bar one high, okay? So you will learn exactly how to scale in 1 time, 2 time, 3 time in any conditions. And this is actually really good, and it's free. So go and watch it. I think you'll learn a great deal. All right. just holding a little bit this measurement. I just want to show you guys where that 80% probability, which is we're about to tag it. I think we already did with this bar. So that's 7, 8, 9, 10, 11. Bar 12 is the first hour of close. Okay. So let's see. Look at the RTA chart. We have a doji. So this is bar 12. Hourly closes. Hourly bars are in magenta color. Okay. So we have a doji. Remember, I said market probably wants to go to that midpoint. It was on its, I'm sorry, I didn't say that. I actually said it wants to go here, but if it can't go close above it, we're going to come back to that midpoint. So what happened there? Okay. So we opened up here. They try to go higher, right? And it failed. Yesterday they failed. So today they try to go higher, first to this and then to that. They couldn't even tag it. So now they're buying at the lower third of this trading range, right? So the lower third starts from here all the way to here, and they're buying smack in the middle. They target the half, so they got it. So if they close today's hourly bar above the midpoint, then they're going to start to make their way up to these levels. Right now, these bulls bought here, they're scalping at the midpoint of this trading range that we are in. So what do you do here? We have a trading range, right? So that's the 15-minute bar opening range, and it actually had a measured move down. So if you actually measure this, right, that was your measured move. It reached a little bit further down, but now it's back and it wants to test the 15-minute bar's midpoint. So it can actually continue to go up to 0725 area, okay? It could actually reach the 0725. That's the midpoint of the first 15-minute bar. Are they going to be able to? Right now, we got the 80% probability, and the bulls are happy. So they have fixed, but they seem to be wanting their 60% probability of reaching their complete full break even. And where is that? That is either the bar 1 close or bar 1 high, right? Because like I said, they're totally drailed here. So they're going to buy again to bring it up. Can the market be bullish today? Can we actually go above this level and we get a spike, pullback, channel up all day long for the rest of the day with a couple of pullbacks to the moving average? Let me show you guys an example. When you have more bars at the open, so what you do is you have more information, right? You're trying to find a blueprint of what the rest of the day can do. So what you do is basically you go to the brookstradingcourse.com, you log in, and then you go to the Brooks Encyclopedia chart patterns. We have thousands of charts here organized, okay? So you find how the day opened, right? So is it a big gap down, big gap up? Well, it opened with a big gap down, right? What does that mean? That's gap down from the moving average. Why? Because we opened here and then we went up. So initially this was a gap down to the moving average or from the moving average, and then we went sideways and down. So I would look for a gap down, right? And I would find the common outcomes, which is right there. And then these are all organized. This is Al's homework, over decades of homework, finding the charts, the common price action. There you go. Gap down means open below yesterday's close, which we were. However, I also include slides where there's an open above yesterday's close and moving average. But the first or second bars are big bear bars closing below the EMA. Now, we don't have big bear bars. Bulls show something and then they got drailed. So let's find something. Oh, look at this one. Look, we went up to the moving average and then immediately came down. Now we're going back to where bulls bought, okay, possibly. And right, so they're trying to get above the moving average. What do we need for always and long? We need Good looking 2 bars. Now, the first bar and the second bull bar, they're kind of overlapping. And then the third one is 2. So to me, this whole 3 bars is a one big bull bar and a second bar. Yes, we are always in long. So now we're closing above the moving average. It would be better if we can get the second bull bar close above the moving average. That will be official always in long, that you would look for follow through back to where the bulls got trapped. And that's what it's doing. Look, if I follow this, this could be today's price action, okay? But you want to see bulls staying above the moving average, going higher and then coming back down. Look for, what is this again? This isn't a spike and channel. This is a spike, pullback, and channel with 3 pushes. 1, 2, 3. Where does it come down? It comes down to the pullback portion. If it cannot close a bear body, we're not going to go down. Instead, we're going to go back up to these highs. Now, the rest of the day, it ended up actually swinging up with a leg 1, leg 2, leg 3, but failed and closed around the moving average. So this could be what we could have today. Another one is here we go. That was that chart. The other one is, look, is we came down from the moving average. Let me make it larger. Is 50% of days with strong sell-off on open have major swing reversal up. So is this what we're having? Yep. Weak bull bars, but I said fundamentally bulls are showing you something, and that is pull back up. So now we're above moving average, but they already pushed 3 times. Pull back. Second leg failure, so this is a bear flag failure, and the bulls take over. Goes sideways for a couple of hours and gets a end of day bounce from the moving average. Maybe, we'll see. What about this? We came down, we go up, and we form a bear flag. That's a lot of selling. You want to see an impulsive bar, a gap bar closing way below the moving average, gapping down, then you can sell and expect several legs down to those lows. It is possible. But right now we pull back to the moving average. We could go sideways and then get that breakout, or we go sideways and not able to get a breakout. We form that. What is this? This is the bull flat I was talking about. They try to get a double bottom but fail to break out. When a bull flag fails, bears try to take over. They turn it into a bear flag. You got to wonder, when something sells this much, it always wants to test the low. If the bull flag is not breaking out with that leg, that means it's not a bull flag, it's something else. That's because it's a bear flag. So now you want to see that neckline, maybe double top, triple top, but that's neckline broken with a bear body. Expect side leg, sideways and down with a couple of legs testing these lows. Okay, so let's watch what the price does. Is you should have been bullish and you should have been waiting for bulls to break even. They're not only break even, they're also now at their 60% probability of break even. This is a full break even now. You see, V-shaped recovery, sharp reversal. We don't call it V-shaped recovery, we call it sharp reversal. And that sharp reversal was the 80% was there and 60% was there. So now those bulls, if they exit, we can finally pull back maybe 33%, 50% of this leg, because we have not taken out that high. But where are we in terms of this trading range? We have a huge trading range. We found buyers at the lower third, right? L stacks these trading ranges. Lower third is a buy zone, and somewhere in the middle they start at the buy, and the target is here and here. Okay, I'm going to take a quick break and be right back. But right now they're taking profit. These bulls are got a full break even, and they are now happy that they fixed their trade. Most likely they also made money with buying down below here. That's average cost, like dollar average cost. So with that contract, they're making money, and now they're taking profit. So they fixed the trade. All right, profit taking after full break even is the good news. You're kind of smack in the middle of the trading range. So anybody who's buying here, taking some profit there as well. But I think you got the idea. I think the bulls are trying to get up to these levels. That's the upper portion, upper third level of this trading range. I'm going to get rid of that. We don't need it. I just wanted to show you. This is bar 12. Now, first hour is not all that strongly bullish. It's a doji. There are two types of bars. It's in the cores. Either it's a trend bar or is a trading range bar. So the first hour is a trading range bar on the hourly chart. So that means if you divide this bar into 3 sections, you're at the upper third. Therefore, there could be sellers waiting there. So it's not a trend bar, it's a trading range bar. And you can see is on the lower time frame, bears are trying to sell because they're at the top of that doji's, upper range. So I did say we're probably going to reach on the 15-minute chart 0725. We did a lot better than that, but we're not all that bullish either. Bulls buying this 15-minute bar close, but you're in a trading range, okay, and you're testing the upper third. Now, if the bar closes bullish, there's a high chance we could actually close above 1775, which is the top of this 15-minute bar marked 1775. We could finally get that breakout. Now, I'm going to get rid of that so you can see. Remember, I said at the open, I want you guys to pay attention to this tight trading range. What did I say about tight trading ranges? They're balance zones, they're magnets. So if we're coming from down below, bears will try to sell twice. That's the first time they try to sell, failed. Because this is a bigger trading range, buyers showed up here and we ended up going back up. So this is the second time they're trying to sell. If the second time it fails and we start to close bull bars above this balance zone, then the bulls will take over. The first pullback they're going to buy. They might buy the second pullback too. However, if the bear is able to close strong bear bodies, then they're going to look for a follow-through bear bar and they're going to sell and swing back down to these levels. So it's deciding right now, okay? But it's working exactly the way it's supposed to work. So right now they're deciding whether or not get the actual breakout from the Globex range, or is this going to be the sell and swing back down rather than go sideways and up? You guys can hear me, right? You should be able to. Some people are sending me messages, but there's nothing wrong. It's probably your settings, or I assume you can hear me. Okay, good. So this became a trading range, okay? And bears trying to move underneath the moving average. Bulls, here's I was trying to put a sharp reversal, but think of it as from the moving average we come down, right? Ours is a lot stronger, and then we reverse back up to the moving average, right? We do come down underneath the moving average, but after that, it's a small pullback bull trend lasting for several hours into past midday. So sometime around bar 48.50, I bet it is, around 1:30 p.m. Eastern time, we get a really nice swing down, right? So bulls couldn't sustain this going up, but really it's a measured move in a way. So this projected up probably reaches the measured move and then comes down right back to outside trading range area first, bounces, because this is pretty strong, probably needs a second leg down, eventually reaches these levels. So we could get also something like this, but we need to remain above the moving average, and trap the bears is underneath the moving average. Bar 14 is strong, outside down bar. It's actually a breakout mode now. It's an inside bar 13, 14 outside. Another inside bar IOI is at the moving averages. We're kind of going sideways because moving averages are jumbled up. Bulls want to keep closing bull bars and then break out to the upside. Bears want a second leg down. Bar 14 is pretty strong. They want another leg down. But look what's going on here. We are back above the open of the day, open of the week, open of the month. So bulls, more bull bars that we close, especially above the inside bar, is bulls will in turn want this 25 tick above. That's 13, 14, bar 15. But it would be better if they actually close the bull bar above the inside bar first. They can bring us up to here, but bears will be present there wanting to sell it back down. My only problem buying here, which I will not, this right here is the bear bar, probably needs another small leg down. So if you're buying, at least look for this bar to close above 13, 14, bar 15 high, okay? Otherwise, bears can sell and bring it down back to the moving average and below, because that bear body probably wants another leg down. If you're long, then you stay in your long, right? You're obviously both down here, got your break even, and you saw these desperate bulls got their break even, but now this outside bar is pretty strong, right? Bears want to sell this, get another second leg, maybe even a third leg with a stop above this bar. So they haven't really made any money because nobody wanted to sell at the moving average. Bulls see, nope, this is a sharp reversal. Therefore, it's kind of like a cup and shallow handle, and they want to keep going higher. So bulls trying to hold this, but bulls are not stupid. They know a bar like 14 might need a small leg. So they might try to sell again. But any failure of selling, and we actually take out the strong bear body, that could create a small pullback bull trend that could last for several hours. Now, granted, in this example, we have 2 bear bars, so that basically the second leg. But actually, we're right here, so we're actually printing this. So that was the second leg, right? So think of it like this: up on this, down on this, up on this, down on this. Maybe it failed already here, so it's trying to get back to up here. So in small pullback bull trends is when strong bear bars are violated like this. That means bulls able to close above the open of a strong bear body. That is like the first sign or first marking of, to me at least, that possible that's bullish pressure. So small pullback bull trend could start, because that's telling me that the bull's able to buy the close of a strong bear bar. They didn't really move underneath. So the next bear bar, they could buy underneath that bar, and then able to actually invalidate this bear body by closing bull bars and bodies above its open. That, to me, you can even buy right above that bar. You could buy any bar. Okay, so you would expect follow through buying, and you would buy every pullback. Pullbacks would be 1 or 2 bear bars, and then you would just keep buying underneath those bars and above those bars. So it hasn't really decided what to do. Bears are still struggling. They want their second leg, is at least given a chance to sell back to the moving average or to the close of bar 14, which is what they sold and trapped. Bulls know that they are desperate. The bears are desperate. So they're trying to invalidate their case even more by closing more bull bars. So that means the open of bar 14 seems like a good place bulls want to test. All right, so you got two bull bars here. Both of them are inside bars. We are at the midpoint of the outside bar. It is a okay close. So even if we come down, there will be buyers underneath. Let me see. 13, 14, 15, 16, 17. I have a 17. I have 18. All right. That's bar 17. Even if it comes down, if it does, buyers will be underneath bar 16 waiting. So be prepared, because bears technically did not make their second leg. So they want to sell and get back closer to the close of bar 14. Buyers will start to buy again, probably from underneath both of those bull bars. They're going to try to prevent bears selling. But if you're wondering why this bar had to come down, I would stay in my long and I would not exit out of anything. If you're still bullish, if you're bearish, don't sell anything. And there you go. We're about to test the bar 14 bear bars open. Have we? I don't think so. No, we came very close. One tick failure, but the bar hasn't closed yet, so I can't really call it a failure. However, these are three inside bars. Bears can still sell. Sometimes you get these three inside bars. That could be an inside bar failure if this bar is bullish. And then what the bears do, they wait for bulls to get there, and then they sell and reach these, or try to reach those lows. If they cannot, so say we go up and then come back down and fail, then the bulls take over once again. Okay, so goal is to get back to where the bulls actually bought. Now that this was a break even and take profit, now those weak bulls took their break even finally, and if they weren't so sure, they exit out of the market. More bulls can come in and they can go back to their original targets, which I called. That was around 59.20, okay, which was right there, 59.25, and then further up to 59 like 28, 27, maybe high of yesterday. I don't know yet. So we still have to close bull bars up here. And the bears are disappointed. They want to sell and bring it back down to the 14 close, because that's where they sold, probably, the close of the bar. But it's two bar side by side. That's small limit order market. Market cycle, when you study market cycle, L Brooks's market cycle in the course, okay? Everything's a cycle. So you have is right here a trend, but it's in a trading range. Every trend goes sideways into some kind of a trading range. Okay, so my only problem here that this was a second leg. This was a trend, came down, sold, maybe the second leg. It went sideways, but the bulls took over. Okay, bears are disappointed because they couldn't resume the trend and sell. So they want to eventually bring market down to here. So they have to sell again, at least bring it down to here and start to close bear bodies. That's how they get to here. So watch if the bears are able to close bear bodies below the close of bar 14. If they do, look what happened. Third bull bar ended up closing bearish. So it's inside bars, three inside bars failure, or that's what the bears are trying to set. So that means they have to come down and test here. If they come down and test but not able to close bear bodies, that will be a failure for bears. They will exit out by breaking even, and then you look for bull bars closing. Sometimes you get them early because that means you're in a small pullback bull trend, right? And then you continue to buy. So if you are still long and you see this is happening, don't just exit out of your long. Market is not telling you this is turning bearish, that it's going to sell all the way to the midpoint of this bull leg in a trading range. It's not really telling you that. It's just scaring you. In the meantime, it's actually forming some kind of a flag, bulls want to go and test those highs most likely. So if the bears fail here, is they try to sell above this small trading range at the top of a upward third of a trading range with bar 17, is they might have already have a break even. Now I'm going to try to do this scientifically just to show you. So say this is your trading range, right? The upward third starts right here. That's the 66% to the threshold. So they lace this area starting from here with sell orders, okay? And a couple of them already activated. So where did they get stuck? They got stuck selling this bar's close, probably. So if the first sell was right there, now I'm going to get rid of this. Now you tell me if those bears actually gotten a break even. Heck yes. Look at that. Even made a little bit more money, maybe just to cover their commission loss. So now they exit and the bulls are coming in. So could this be now continue and resume to go up, but I still need this open to be violated, meaning bulls need to close above bar 14, open a bull body. So you can see although the bar hasn't closed, but I could see that these bears sold at the upper third. I remeasured their quick break even and look, now why aren't they continue to come down? Why? Because that was the average cost, dollar cost average break even. Only if the bar closes below it, they can continue to come down and go further. Since we have nothing there, bulls are wanting to get up there, close above it. Now they're targeting this. Because machines know how bears measure, and they know that the bears couldn't continue and they exited, so now they're buying into it. They want to run the stops above this bar 14. Their very first target is right there. But bar has to still close above the open of bar 14. So we're just about there, 1325. We need to close around 1350. If the body closes above 1325, these bulls are gonna keep climbing up. We broke out of a 15-minute opening range with a bear body. Wouldn't that mean, what do you mean? I don't have that kind of bear body. This did not actually break out. Where's the bear body that would broke out? You mean to the downside? Oh yeah. Oh, sorry. Yeah. I mean, they got their measured move, right? So they got their measured move. Your question is, wouldn't that mean we would get at least 1 hour to the downside of the? Yeah, we already got that. You don't see this one? That was their measured move. So it reversed back up now. So it's probably want to get up to here, 28.50 and higher. Make sense? If you guys have any issues, please post under support. I mean, I'll alert the admin. All right, so bulls did close a bull body. Good job. So their target is right there now. They're exploiting the situation, and great job, bulls. So you could have bought again. But let's see if they can actually give us that target right there. That's the 1 hour target of the exploitation of breaking even. So I like to see continuation and get that 59.18. I reported the delay issue to our admin. I know what he's going to say. And that's exactly what he's saying. So there's not much we can do about it. You can report it to GoToMeeting, but it shouldn't affect the quality of calling the price action. All right, so we are, or is it? I don't know. You're more than welcome to post your feedback. Right now, I am, this is bar 19 forming, and it says 3 minutes and 17 seconds, 16 seconds, 15 seconds. So this is where's my bar 18? All right, so bar 18 is if we close more bull bars above bar 18, we're going to continue to go up. I want to see bulls actually exploit and get their target. See 59.18. They have to keep closing bull bars. Eventually, we will pull back to the moving average once again, but it would be better if they get the follow-through bull bar. So follow-through bull bar is, I don't know if it's follow-through, it's trying to be one. Bull's still targeting this price level, 59.18, but they need to close this bar as a follow-through bull bar and break out from this small flag trading range, okay? So what happens is, just like any flag, okay, you have the flag, you have the flag pole, you have the pullback, and you have this trading range. Bulls buy the pullback, but they know that when they get back up, okay, they buy with a small contract size. They don't go in with a huge lot because they know there's always sellers up there. This pullback, there's sellers there. Bears are disappointed they couldn't get their sell off. So what happens is, just like any trading range, when price goes up to the range top, this is where machines start to take profit. It's not guaranteed the breakout will happen fast. So that's why we end up stalling here, okay? You might have target or targets. They don't mean anything. They don't mean anything. What's most important is when you are in a trading range and when you're buying a bull flag, flags have or can have, that's right there, what I'm trying to say, and it happened faster, can failure to break out. So what you do is, if you buy here, you have to take profit at the top of that trading range, whether it's the bigger trading range or the smaller trading range. Why? Because bears couldn't sell it and bulls take over and exploit it. Those bull machines, remember, 80%, more than 80% market is traded by the machines. Those machines know if you're in a bigger trading range, at the top of a trading range, flags can fail to break out 75% of the time. And right here, those machines are scalping. Okay, they didn't enter with the full lot. They only bought a little bit. Once they start to see bull bars closing, then they add back more contracts. But they know, everybody knows, that if you are playing into any kind of flag, flags can fail, especially at the top of some trading range. They're going to challenge you because these bears were already challenged and they didn't get their continuation second or the third leg. They're utilizing the top of the small trading range and as a failed breakout to get back down again and get a better price break even. Okay, so what do you do if you buy here at the moving average? You got to scalp all the way up here. You don't have a swing yet. It's not confirmed that it's going to keep going up. It is still small pullback. Well, I don't know if it's a small pullback bull trend. It's still trying to be one. So what do you need to see here if this is a small pullback bull trend? Look, after this bar, bulls bought. It didn't get a follow through. After this pullback, bulls bought again. In fact, it went, remember I said way before bar 17 happened, if there's any bear bar, again, look to see this time if they actually buy below that bar, okay? It started with buying the close of that bar. Now the second pullback, they bought one tick below 17 and closed way above. So that right there is continuation, small pullback bull trend, trying to become more bullish, okay? But it's not there yet. It's not all that quality, okay? So now is we are trying to see what else they're going to do with this pullback, right? So I don't know, we could still come down one tick below. This time we could have two bear bars, and then I would look for bulls. When do I give up on possible small pullback bull trend? When the bears start to close below the moving average and start to take out strong bull closes, such as bar 18, such as bar 13, such as bar 12, open and lows with strong bear bodies, okay? That means this is not a small pullback bull trend that you should not be keep buying this. Okay, so far so good, but the bar needs to close bullish in order for bulls to resume the trend up to that first target, exploitation target I call, after running stops. They're already running stops, but same with the bear flags. You are spike pullback, right? First sell goes up, right? Everybody's buying, they will sell again, right? But the buyers are here. Every bear knows, the machines know that if they're selling and looking for a breakout and swing, sure, they're not going to get it. Bulls will try twice. Bulls trying twice, maybe they're trying one more time, needs to form a lower high, then they sell. Okay, so this one is bullish, it needs to form a higher low. So maybe that's what they're doing right now. They moved underneath that pullback bar. Now the bar closes bullish, we're probably going to test that 59.18. So this is bear's second time trying to break out from this small trading range, flag range. But we're still below the close of yesterday. Still doesn't look all that fantastic for bulls, but it's bullish. It's always in long. It was trying to be always in short. It did become for a while, but you're selling to the bottom of a trading range, right? And buyers are probably there. So now they turned it always in long, but they have to resume and keep closing bull bars, this time above the magnet. I don't have that, so we're going sideways. We're still in the small flag channel. Bulls might want one more push, maybe 1, 2, 3. Bears see wedge top or wedge formation. They want to squeeze out of it to the downside, but they need to show us that they can take out very strong bull closes within the range or underneath the range, which is bar 12, with bear closes. Then they can bring price down to here. So right now we're going sideways because it's a limit order market. Both sides are betting against each other. So therefore, you're in a scalp mode. You can see bears trying to gain some control. They want the bar 18 low and bar 18 close invalidated with a bear body close. So this bar 20 needs to close below the open of bar 18 and the low of bar 18. That will be the first sign is bulls losing momentum. But technically, we're still above the moving average. We don't have bars gapping below the moving average. Bar 20 body closed exactly where bar 18 body opened, so that does not count. Bears not all that strong there. Suddenly, this bar 21 closes bullish. That's because bulls are given a fight. Now, if this bar closes bearish, what's the next bar they want to take out? Is bar 12. But will it close? Sometimes it looks like it's closing bearish and then everybody sells right underneath this bar so close to the moving average, and then this bar goes and closes bullish. Every bear gets trapped there. This is why you need to follow the breadcrumbs, follow the rules, okay? Look for confirmation before you say, oh yeah, this is bearish. 2 bear bars, I'm selling underneath, I don't care what happens. Well, when this happens, you will care deeply about your loss. So at least wait, okay? Bears want the third bear bar sideways and down. They want to sell. But why didn't they close bar 20 body below the open of a strong bull body or the low of bull body, which is bar 18, I said? Well, it could be a sign bulls don't want that to happen. So they're buying, bulls are buying at the moving average underneath that bar. Remember, I said pullbacks in a small pullback bull trend can be not just 1 bar, but could be 2 bars. So this is where bulls need to decide whether or not they can control this market and keep going higher. So that means they have to close a bull body. Good looking buy signal bar in the form of bar 21 would be ideal for bulls to come back in the market. or add to their winning position. They're already in the market, that's for sure. So hopefully I prevented you guys selling this bar 20, and that's the whole thing I talked about was to just prevent you guys selling untimely. Hopefully I accomplished that. Now, if the bar closes bearish, that's a whole different story. That would be 3 bear bars, but we don't know that. We're still in a trading range, and it looks like a bull flag. Yes. Now, 18. Yes, it is. It's a bull flag within a bull flag. So yes, bulls are trying to break out a bus. They're trying to break out from 1425. They close a bull body above 1425. They're going to go somewhere up here at the very least. So you wait for the bull close. So who sold the bar 20 or underneath 20 or the close of 20? I'm not going to yell at you. I might, but I just want to know. Hopefully you didn't. But this is how you learn. Yes, it is true. It is big down, it is big up. We already way past that. It's confusion. So we must be in a trading range. Oh, we already knew that we were in a trading range. You were looking for buyers down here. So somebody says here, Rizvan or Rizvan, says, I bought the bar 20 close and made a scalp. That's great. You did that because you're in a limit order market, because I said both the bears and the bulls are betting against each other, so you have a scalp there. So that's fantastic. Is you now have a you went against at the support, you went against the bears. So good job. That's exactly how you're supposed to trade this small trading range. Unless you're still long, then you hold on to your long, and every time it comes down to the moving average, you buy at the moving average, okay? And you can hold your swing and scalp a little, hold your swing, scalp a little. Okay, so basically what this is now, a pullback is for bulls. Bulls want to continue, but they need to now keep closing bull bodies. So this bar, my bar numbering is hideous today. 20, 21, 22. I'll mark the bar 24 because it's the end of the hour. Is another hour. Bear sold below or the close of 20 is selling and betting against a strong bull body because they're stuck. I said they're probably going to trap you, don't sell anything, and because bulls will buy there. So if anyone sold, they got a chance to sell up here, okay, or to close. And look, let's do a scientific. So say maybe you sold close, maybe you sold one tick underneath, you sell the close, that right there is your break even. So now bulls want to close a bull bar somewhere up here, okay, so they can continue to go higher. When does it come down? If the bear is able to suddenly collapse this bar, collapse this bar and close the body below that 50%, then they're going to come down and get a full break even somewhere at the low of this bar 20 or the close of bar 20. So that's what they're trying to do. You don't know that yet. There's 2 minutes and 32 seconds. If that body closes below the 50% of this measured range where they sold the close of this bar, bull bar, they could continue to come down. The goal is to always get a full break even, either at the close of the bar they might have sold or one tick underneath bar 20. Bar 21 is not all that great of a buy signal bar. Yes, it closed on its side, but it's a leg in a small trading range. It is a doji. It's got an upper wick and a lower wick. So this bar is kind of a doji, but it's a strong bull close. So because you're in a trading range, it can be a trading range bar, so the 50% pullback could happen, and that's what's happening here. They're still trying to control the market. This time they want to actually swing back down to these levels or to the gap area underneath the first hour, maybe open that bar. No, not the first hour open. So bar 12, bar 12 low, bar 12 open, that area they want to target, but they have to close the bar bearish, not only here, but underneath bar 20. So still more scalping happening, but eventually scalping will turn into a swing. Is it going to be a bear swing or bull swing? Well, right now, this is still a bull flag, and bulls are still having a hard time breaking out. What do you need to see for is trading range cycle to end and the swing to start? What do you need to see there? It's in the free trading range, trading days, how to use the encyclopedia webinar file that is posted on the Brooks trading course. What do you guys need? Yes. Well, no, well, I'm not seeing my answer there. What do you guys need to see in this trading range? You need to see 3 legs for bulls and 3 legs for bears. This is the most difficult one, but it is there. Here's the first leg for bulls, the second leg for bulls, and the third legs for bulls, and the 50% of the trading range. What about the bears? First leg for bears and a second leg for bears, and they're trying to get their third leg. If that third leg fails and we stay above the 50% of the trading range, and then suddenly we start to get bull bars, this is going to squeeze out and then bulls will start their swing long. However, if the bears, this leg is still happening. If the bears actually start to close that bear leg somewhere down below the 50%, that means they want to target the low. And if they do that and get a breakout, you look for a pullback and then you start the short swing. Right now, we're above the 50%, so probability is favoring bulls to get the breakout. And it's also a squeezing or trying to squeeze out. So bears got their break even. They couldn't close the bear body below the 50%. Bulls now need to close bull bars if they want to break out to the upside, but we don't know yet. So it could suddenly start to actually break out to the downside. What do you need? Measure the trading range, say this is your trading range, right? That is your 50% right there. If they start to close below it, bear bodies, they can push it all the way down. I like to measure my trading ranges, excluding the wicks, okay, to stay a little bit more accurate. So technically we're still above the 50%, but it is the third leg, and the third leg for bears hasn't been completed yet. So if you're trying to time your breakout and the direction of the breakout, okay, you're going to have to always count okay, if you are new here and you don't have access, wait, that's not what I'm trying to do. Hold on, let me get this. If you're new here and you're trying to get, you don't have access to the course and you want to learn about how to trade the trading ranges, go to the search function on the brookstradingcourse.com, type encyclopedia, hit search. Very first one, using the Brooks Encyclopedia chart patterns, click on there and then scroll all the way down until you see someone with red glasses. That's me. So click on this and watch this, okay? I kind of, well, with the permission of Richard, I wanted to turn this presentation, rather than just how to use the encyclopedia for trading range trading, I wanted to turn it into more of a how to learn to trade trading ranges and trading range days. So it's pretty long. I kind of irritated my teammates for having such a long webinar that day. I should have not done that, But I think it is overall, it's a very good resource if you want to learn about it. It's free to you. Go watch it. And in there, I'm explaining with examples the rules that by taking L's course and seeing how these trading ranges actually break out in the right direction and how I find it, I studied the trading ranges, small or large or medium, and then came to a conclusion each side have to have 3 legs, okay, before I actually time my breakout entry. And before it happens, what it does to you is actually pretty ironic. This is why everybody lose their accounts, because they buy, they sell, they don't sell, and then they're holding a bag, and they don't realize, wait a minute, there's no third leg for bears yet, so why are we coming down? They don't know, because most of the time traders don't study, but you have to. And even on a larger trading ranges, you're gonna see, like there's one right here, for example, right? So it look leg 1, leg 2, leg 3 for bears, small leg, bigger leg, and this is the third leg. So if this is a trading range, right? Okay, and we're already above the 50%. Bulls are way far away from the high. Or you can say, okay, I'm going to do what Rose did. I'm going to exclude those. I'm going to tighten this up a little bit. Technically, we're still above the 50%, but we're far from the edges of the trading range. So where is the breakout? You don't even know. So this can go down, up, down, up. You cannot assume this is going to break out to the upside. Or here, take this as your trading range, right? So get rid of that. So where are we? Maybe this is your trading range. I think it would be wrong to measure it this way because you have a much bigger trading range. So there's no point doing that. Take this one. You don't even have, like you have bear leg here, bull leg here, bear leg here. So where are the other bull legs and bear legs? We could be going up and down in this range until we complete those legs. We print those legs. So it could actually come down more. But obviously, you're not going to sit there and wait for that form. You're going to look at this tight trading range, and you can see right here, that's leg 1, leg 2, and that is the third leg for bears now. What about the bulls? Leg 1, leg 2, leg 3. Bulls are failing to keep the market above the 50% of this trading range. So what's going on there? That's because bears are like, we need to get our third leg, and that's our third leg. So what do they want? They got their break even on their bar 20, which they got stuck, right? So now, I think this is 20, 21, 2, 3, 4. So this is the end of second hour. They're trying to close it bearish, okay, below the 50% line and sell some more. What if they fail? Can bulls show up here? Well, you're still in a trading range. But if we start to get the breakout, we could pull back and then sell. So what do you do here? So if I were not long and if I were not holding and I needed to buy this, I would not have bought anything unless I see a bull breakout before I see that third leg finish. So bear's now trying to control and they're trying to sell, but will they get their breakout? They're trying to close below right there. Now, somebody asked earlier, is this a bar 18, 19, 20 auction? I said yes, but what do you need it to see to go long? And did you get it? A bus. What did I say there? Did you go long? Because if you did go long, then you bought too early again, You needed to see a bull bar, this bar closing bullish. It didn't. So would you buy it? No. So you're still stuck in a trading range. Okay, so now is bears got their third leg down, but technically still at the low of the trading range. Bar hasn't closed yet. There's still 45 seconds for this bar to close. We don't have a bullish breakout from the 15-minute opening range yet, but bulls can show up. If this bar closes bearish on the 15-minute chart, is bears will sell the close of the bar, most likely. Bulls are trying to prevent the breakouts, bear breakout, because they know bears can bring market down to here, measured move of the small trading range. They also see head and shoulders pattern, left shoulder, head, right shoulder, and lower high. We don't have a breakout. All right, so the second hour came to a close, is yet another doji, but it's not all that great. Since we don't have a breakout from the low of the trading range, I can't really sell this yet. But 15-minute chart, bears are selling. And what about the bulls? Can the bulls buy? Since there is no breakout, bulls can also buy and reverse it back up. So it's still not clear. Okay? You're still stuck sideways. It is 11:30. I'm going to open the question box. Give me a second. Oh, wait. I may not be able to open that question box. Let me check because we've changed. I think this is a webcast. Hold on. Okay, let me see. I think it might be just the Discord, but I'm checking. I will try to open it, but that function may not be working because we've changed from webinar to webcast. I think that allows us is so many more people to join, but the question box function won't work. However, you can, in the meantime, you can post your questions on Discord and tag my name and I'll try to answer anything that I see from there. Oh, okay, so it is verified that it's only is Discord. So I cannot take any questions from the GoToMeeting webinar. It does not function. So please post your questions onto Discord and I'll read them from there. Okay, so the first question, I think it's a question. Bears broke the neckline at the lower wick of its bull bar 18. So why is it still a trading range? Bulls also failed 3 pushes up. Neckline 18. To me, neckline is right here. Well, this is a micro double top, and that's the neckline. Nothing there, so we go back up. Now we have a double top. Okay, you can use that as a neckline, which we didn't really break below it, but really this is the neckline. So if there are any sell orders, they're probably underneath this bar. So I don't think bar 18 is a neckline. You're smack in the middle of a trading range there. Yeah, someone's saying, what about the bad buy signal bar 7? Could that be? Well, if we start the breakdown, oh yeah, first the 50% of this leg in a trading range, and then the bad signal bar 7 would be your target is always. But we still need bears to break this trading range and then take out the neckline. Okay, that bar right there, bar 14 low with a bear close. Then they will probably gonna resume the sell-off or sell within the trading range. But first I need to see, say this is your, okay, double top maybe either that or that. Okay, so we closed below, but not here. You're still in the trading range, so it's still not clear for bears. We don't have these bear breakout just yet. Tight trading range is right here. Tight trading range here. So bears trying to get the breakout to the downside. There you go. Finally, I think we're going to get that. So since this is a trading range trading, what's the magnet? Open of the day becomes magnet. Would you exit out of your long here? Well, if you're worried, sure, exit out, because we are now 2 bars closing below the moving average. One of them is actually gapping down. You could say this is now always in short. You can exit if you're worried. We now have a breakout by bears, but it could still pull back. So measure the 50% of this leg and see if we can reach there. Bears want this target right here. First the open of the day and then down here. Other bulls are still holding. They want market to get back above the moving average. Remember, I showed you guys an example that in the example, let me see if I can, where was that? Is we actually moved underneath the moving average and then started the buy, okay? So tight trading range, looks like breaking down, right? Problem here is that the breakouts fail at around the trading ranges. This is the actual breakout for bears. What do I expect always after a breakout? Pullback. Pullback could be going up to here, there, or even all the way here before they actually sell. So you have to look to see if the pullback is going to be sold, right? Because look, breakout and then pullback extends. So this fails and becomes a bull flag. So that could happen to you. So if you're worried, you can exit, but you don't sell. Okay. But if you're still long, you hold. At least look to see if breakout bars close above that threshold, and that, then if we suddenly start to close, that is a failed breakout and bulls can take over. So I don't sell right away just because we have a breakout. It is pressure for bears. If you sold, then you're going to have to hold it to see if we can actually get down to the open of the day. We have a trading range, right? We have big down, big up, sideways, okay? But still trading range day, open of the day is magnet. So now I'm watching, will the pullback will end here and the bears finally will sell and get there. That's when you sell. Maybe you could put, they already sold one tick underneath the breakout bar. They're probably now selling the pullback, but the bar needs to close bearish in order to keep coming down. If bar starts to close above that green line, anybody who sold will sell again, break even, and exit out. On the 15 minutes, is bears selling. Like I said, they're going to sell this bar close. They did, and they made some money. But in the meantime, bulls are also wanting to buy and get back up. So because it's a trading range, as much as sellers at the close of that bear bar, there are also buyers underneath the bear bar. So that makes it very difficult to see if the bears are going to succeed here. All right, I'll take more questions. I saw the bull who bought over bar 10 being disappointed with bar 11 and 12, and that is why bar 13 went to the entry level and sold out. Hold on, guys. You bought the bar 10, which is right here, 7, 8, 9, 10, which was a doji above bar 10. Disappointed with 11, 12 is because you're buying into the upper third of the bear leg. Well, you shouldn't be disappointed. Why are you disappointed? Because you were looking for a quick breakout? That won't happen, right? So bears selling here, they're going to sell somewhere up here, okay, to break even. But if you bought there, you're basically going for, right? So bull bar close, you can measure it several different ways. You measure from there, you know this, you learn this. That's your target. So you would take, so you bought a little late, but you would scalp there and you would leave a runner. Others will measure from here, they buy the pullback, and what the bulls want is that target. They got this one. They even, I think, got a 50% there. Yeah, no, they couldn't. They actually failed to tag it. One tick. Yep. But eventually this is where the bulls want to go. So those bulls could be still holding. What about the bears? They put their stop. They see they're trying to come down to this target right here. Let me get rid of that. They're trying to come down to here. But then look what happened. They sold the close of this bar. They couldn't sell one tick under because it never went there. They sold the pullback and then disappointed. But because of this is the bar that they eventually sold at the close. They sell at the upward third, price comes down, and they have a break even. So all they do is a break even. Now, what about, there is no bull set up there. Maybe there was one right here. Bulls bought the close of bar 18. They were looking for this target and that target. They failed because they're buying, right? They see too late. This bar, strong bear bars open, is taken out 1, 2, 3, 4 bars later. But they bought it. Maybe they bought above. Then this happens. They buy at the lower third of this bar, signal bar, or the trigger bar they bought. And then with this bar, they break even, and then the bears take over. Why? Because bears needed to bring price back down to there. So now bears did that, but they're not able to close below it, so they're not able to come down more. So what are they doing? Now the bull bar closes above that strong bear body. I'm showing you guys how I scalp. Okay, if bar closes like that, that means bulls are going to here and possibly there. They're already trying to get there, but they don't have actual signal. By the time we reach there and the bar closes around here, you buy here, you're going to be stuck in a pullback. So you can't really buy if price already reaches your signal bar is so big that it already reaches the first target. You don't buy. You wait for a pullback and then you buy. What if the bar does not close is above this bar? So that's 18. 19, 20, 21, 22. Hopefully I will fix this soon enough because I'm getting tired of marking the bars. 23, 24, 25, 26, 27, every 5 bars, right? So you have bar 27 fails at the close 1 minute and 47. And then what do? Then you don't buy, obviously, but this one's already trying to reach the target. So you can see this is, what do I call this? What kind of bull flag is this now? This is a bull flat, so it's still a bull flag. So it's trying to reach up here and get a breakout. So bull's about to take profit there, but what if it closes above and reaches there before bar comes to an end? I didn't sell this. To me, this was the double top and neckline. None of those sell orders are activated. Bears did not clearly break below that low. Yes, they broke this low. If you measure your trading range like this, yes, they did. But that is the very first breakout. And what happens to the first breakouts? They get violated. And what's the bulls are doing? They closed above the threshold, and the bar that broke that initial trading range low. So now those bears are totally trapped. I didn't sell that because this is bullish enough for me to say it's the second time bears trying to sell. Yes, we gapped down, kind of, but why aren't we getting follow through? To me, we're still clinging to the moving average. There's no sell there. I needed to see what the pullback was going to do. Okay, so bulls got that. So, but let me show you again. So if you are a bear, okay, and you sold this bar 25, and then this happens. I told you guys this can pull back to the green line. That and that, if we close above this, then we might be having the third official leg here, maybe the first leg for bulls, or maybe the first leg for bulls and the second leg, maybe this is the official third leg. This trading range still goes. So what do you see? Say you sold, okay, maybe sold one tick under, and this happens, right? You're gonna sell again. Eventually, bar opened here, right? So everybody sold at the top of that bar that they sold, the close or low. And it came down, it opened right there, okay? Look, they sold there, bar closed there, right? And then this one opened here. So basically these bears are getting their break even before this goes up. Other bears, they're stuck here. They could sell at the upper third also and try to bring price down, but not with bar 27 anymore. So now bulls are above the 50%. I think the bears are in so much trouble now. They're going to exit out so fast without fixing anything. We can finally get that breakout to the upside. Then where would be your target then? Your target would be up here. I'm only using this trading range. Now, what if you use the entire trend? Yeah, that's fine. Then you don't even have a breakout. And now we get above the 50%. So the bulls are now trying to get back in control. So what are you now looking for? You have a double bottom, bull flag. Now you're looking for a breakout from here. But just like same thing happened here, you're going to look for a breakout. You want to see a bull close, not a wick. Then you're going to look for a quick pullback, and then you can buy. Always that pullback. I did say there will be sellers at the close of this 15-minute bar. They did sell and made money, but look what you're selling into. And I said, as much as they're sellers, they're also buyers with that buy because they see a bull flag. They want a double bottom around the moving average, keep the gap open, and they want to get back up to the 15-minute bars high. And that's what they're doing. So if we start to close bull bars above 1775, market is probably trying to get to the 59.28, 59.24, 28, and then further up to 59.38.50. That's way above somewhere here. That's above the high of yesterday. All right, so what are we looking for? We are now looking for a breakout. Okay, pullback. Like I said, anytime you have a trading range, that's a decent breakout. Probably they're going to buy the pullback, whether at the high of the trading range or slightly inside and trap and go. We don't even have that breakout yet, so we're still stuck in this trading range. Therefore, we're going sideways. So smart bulls are buying at the lows. Smart bears are selling at the highs. Stuck bears are disappointed. They might be trying to sell one more time, bring it down, but this is now becoming very difficult for. Oh yeah, I can see the lag. I moved the encyclopedia slide, and okay, now it's disappeared. I see the lag. I guess you guys weren't making that up. I just saw the lag. All right. We don't get that kind of lag on regular days. We have quite, 4 digits attendee numbers here. I'm not going to say it, but that's a lot of members here. So it's a free, and lagging can be a little bit strong, but on the regular days, we don't get this. It's only a couple of seconds. All right, I have about 10 minutes, so I'll take a little bit more. I hear Al saying that if low 2 is a better price to sell, it is probably a trap, but it isn't wedge bull flag always a better price for bears? Well, depending on the location, I think. That's how I look at it. So where's your low 2? Which bar is low 2 then? What are you counting as low 2? This was the low 1 and this was the low 2 from this morning. This was high 1, maybe this was high 1, high 2, high 3, high 4, or today, right? So that was, they couldn't even get above it, so that was the high 1 and they sold, but to me that was the low 2 sell. So now we rallied up, so you should be counting for high 1s and high 2s. We rally up, first pullback, buy above 15, right? Second pullback, no, that's still going. Second pullback, buy above, perhaps, right? And third pullback, buy above. But since we took out this one for the second time, to me, this is the second pullback, actual pullback. So this is high 2 above 26 and go long. All right, we're getting the breakout now. Okay, so that's good. But it needs to close with a bull body to continue to go higher or buy the pullback. This is a bull flag. It still is, but remember what you're into. You're still in a trading range. Now we're testing the upper third of that trading range. Bulls want some kind of a follow through. In order to get that follow through, they still need to close bar 29 above the trading range high. If they manage to do that, then we're going to keep going higher. But this, think of this as a maybe inverse head and shoulders. You have the left shoulder, you have the head, and you have a complex is right shoulder, right? So remember I said this is probably a cup and handle, and this is what we formed. We formed a handle a little bit complex, but the bull's now trying to get a breakout, okay? We might actually go all the way up, but I don't know. Right now we're in a trading range. We have arrived into the upper trading range. So if anyone's stuck here, they might try to sell. We might get a pullback and then they could buy that pullback. So anyone who's long still holding and prevented bears from getting their breakout. So we are now trying to close that breakout body, and bulls want to keep going up and test these wicks. Originally, they were supposed to do it here. They're drilled, so now they go back. I'm waiting for the bar to close to see more bulls buying the pullback. Pullback could be very shallow. Only to the breakout point is bar 19 high. And then suddenly we're gapping up from the moving average. So eventually we're going to pull back again, but deeper pullback. Right now they are trying to reach these wicks. Okay. So my original targets were 59.20, which we reached, then 59.25. Some sellers might be there. So let's see if we can tag that 59.25. But the bulls would buy that pullback even if it comes down from 59.25. Yeah, you could get, that's what I'm saying. You remember what you're in a trading range, and this leg can trap you because we're at the upper third of this trading range. So if you bought down here, which is really good price, you still have to pay yourself. Okay, this bar has about 47 seconds, 43, 42. We're still probably going to pull back and see if the bulls will buy that pullback. I bought about 27 because I kept saying I don't think no one's going to sell that 27. These bears trapped already sold, okay, and then exited. If they haven't, they exited with bar 27 anyway. So I bought the 27 and I'm looking for higher prices. And I got my target 59.20. I want 59.25. And then I want 59, 27, 28 area, if not higher. The high of yesterday is my target. And then one time the trading range projected up. But that's the first breakout bar, which is a fantastic bull bar. But it can still pull back. That's what you get with trading range breakouts. You always counter in the pullback. Okay, I need to end my session. I have 5 more minutes. I'm going to take one more question. What do you mean? Somebody says, why aren't we discussing about high of bar 2 as resistance? I think that's already spent. Look what happened there. That was the break even. The bulls got 80%, and then they already got their 60% break even. It pulled back. Bears tried to sell it, but failed and turned into a bull flag. However, you're in a trading range. Anytime we break out, okay, there will be sellers always above the, find a small trading range, and that's right there. But the bulls are closing bull bars, so that resistance is not all that strong anymore, okay? So now we have a breakout bar. You always counter in the pullback, okay? Depending on how the pullback, how strong the pullback is. Could the pullback all the way come down to here? Maybe, but bulls will show up again. Will trap the bears, right? Yeah, trap the bears trying to sell. So right now I am bullish still, but we gapped up from the moving average, so expected the pullback. I'm already long. I've taken a quick scalp at the 59.20, but I'm looking for follow-through buying. Your last mother bar, which I called already, inside bar, outside bar, inside bar, and I said, as long as the bulls close above this bar, they're going to go target the outside bar's high. That's where the sellers are. We never got a breakout from this bar 14 high. So we came back and tested the 14 low, but we did not break below. So the bulls take over and trap again. So now we have a breakout from that bar's high. This is a solid breakout. Bulls may want higher prices, okay? But it is the first breakout, so we are doomed to pull back. Bulls already bought above, one tick above the breakout bar. They will buy the pullback to the breakout point. Breakout point is here. And they just reached it because they are now trapped from above bar 29 high. So they buy the pullback. They can even buy lower because this is gapped up from the moving average to break even. But their goal is to not just to break even, their goal is to get back above the high of that bar and continue to go higher to the measured move of this outside bar's range projected up. All right, one more question. Why we have different bars? I use TradingView. I don't know. I use NinjaTrader Continuum CME connection. I don't know what connection you're using. It's your data provider. Might be printing different bars. June calendar is not ready yet, so I cannot really talk about. I don't even know who's streaming tomorrow. It could be me. It could be someone else. I don't know, but it'll be posted probably end of day or tomorrow when you guys are ready to purchase the Trading Room subscription. Trading Room subscription is $99 a month, so you're basically roughly paying $4.36 a day. which covers your downloadable recorded webinar files that you can keep and study for future. You will have all month long, whatever the month that you're subscribed, you can download all of those days. I am done with my session. I need to be kicked out of here because Al Brooks is coming in, and then Brad will close the day. So don't go anywhere. Here comes Al Brooks. Thank you, everyone.
Thank you, everyone. This is Al Brooks, and thank you, Rose, for the first couple of hours of trading. As you can tell, I have some laryngitis. I've been babysitting my 2- and 3-year-old grandkids a lot over the past several weeks, and there's always 100% certainty that I'm going to come down with something that I'm spending so much time with them. So I'm sorry about my voice. Today we had a sell climax, and there were 3 legs down. On bar 3, we went down, we went up, we went down, and then up, and then down. So it's a parabolic wedge sell climax, or you could just call it a sell climax. And we have an abrupt reversal up, and then a pullback. And you'll sometimes hear people on television refer to this as a cup and handle. So the sell climax in the reversal forms a cup, and the pullback forms the handle. And it's a bullish pattern, but it's far less bullish than what the people on television make it sound. You know, when you hear it on television, you think it's sort of a big bull trend, but most of the time when you get a cup and handle reversal, the rally is not going to be very big. The market often has to retest. If you have a big sell climax like this, the market often has to test down here. So right now, what's most likely? Well, right now we're going up. The market's going to try to get above yesterday's high. It would like to get above last week's high. We have a breakout, bad follow through. This move up will get us above last week's high. So what's the chance that we're going above last week's high? At the moment, I would say 40%. What's the chance that we're going below the low of the day? At the moment, I would say 40%. Now, we've been sideways here for about 15 bars. And if you add this, we've been sideways for about 20 bars so far today. We broke down at the bottom and reversed up. We're breaking out of the top, but there are problems with this breakout. When you have a breakout, it's more likely to go a long way if the breakout bar is very big and it closes far above the breakout point. And if the bar after the breakout bar has a bull body. Look at this. The bears tried to get a wedge bear flag. Instead, we get a bull breakout and a bull follow through bar and another very big bull bar. Chances are we're going to go up for some kind of a measured move. The leg up began here. We went above. You can see there's some profit taking at that level. Sometimes it'll go up for a measured move based upon the higher rally. A little bit above it. This breakout does not look like this breakout. And when the market breaks out of something, it's more than just a high above the prior high. So is this a breakout of that? It is technically, but I wouldn't refer to it as a breakout. When I say a breakout, I want a breakout bar, which is a big bull bar closing near its high and above the high of the prior bar. I also want it to break above some prior resistance, like the top of a wedge bear flag. And I want consecutive closes, consecutive bull bars closing above the breakout point, which is what we have here. If you get that combination, depending on how big the bars are, there's a 60 to 70% chance you're going to get at least a second leg up and a measured move up, which is what we got here. We don't have that here. We have a bull bar. We have 3 breakout bars. This bar closed above that. This bull bar closed above that. This bull bar closed above that. But the bars are not big, and only one of the breakout bars closed above the breakout point. Whenever you have a breakout, you look to the left and see what it broke above. And here we broke above that high. We also broke above the high today. But we didn't close far above. The breakout bar was not big, and the next bar was a bear bar. So this is not a strong breakout. Maybe we'll get up for a measured move based upon the height of the trading range. Trading range, we have a double top here and here, double bottom here and here, and the measured move up would be just below Friday's high. If we start to get bigger bull bars, or if we get a lot of bull bars, then I think the odds will shift in favor of us going up for a measured move based upon this height. But right now, it's more likely if we do get a second leg up, it's not going to be the start of a big trend. It looks like we may stay in this general area, go a little bit below it, a little bit above it, but right now we have a magnet right here. On the monthly chart, we had a big sell-off in April, a big sell-off in May, and a reversal up, and it's coming in a bull trend. But I think it creates a lot of confusion. This was a huge sell-off, and now we have a big reversal up, and that's confusing. Is this rally a pullback and a bear trend that began here, or is this sell-off a pullback and a bull trend that began down here? It's both right now. The bulls are hoping that the bull trend is resuming. The bears are hoping that this is just going to last a few bars and then the bear trend will resume. And we need more bars to find out. But typically, when you get a big move down and a big move up, you get a big confused market. And when traders are confused, they're unwilling to hold on to positions very long. So the legs up and down do not last. Traders take profits. Also, traders are eager to buy whenever the market is low and sell whenever the market is high. So you tend to get reversals. And the result is usually if you have a big move down and a big move up, you're going to go sideways. How many bars sideways? Well, at least several, probably more, probably 5, 10. And if it's 5 or 10, that means the trading range that began with the sell-off could last for the rest of the year. So right now, unless we get 2 or 3 consecutive big bull bars, it's most likely that we're in a trading range and it's going to last most of the rest of the year. So did this bull breakout fail? Can we short? Well, if you're looking to short a failed bull breakout, you want to see the breakout followed by a bear bar closing near a slow. If not, the very next bar or within 2 or 3 bars. And we don't have that. Bull breakout. That's not a good sell signal bar. But this is, now we have consecutive bear bars, one being big and closing near slow. So that is a reasonable sell signal. We do not have that here. Right now, we have a rally and a small pullback and sideways, but the pullback from the top is still small. We have a new high and again a small pullback. So far, this is a small pullback bull trend. But unless we start to get more big bull bars closing on their highs or more consecutive bull bars, this is probably not going to last all day. This is a reasonably strong rally. It's a breakout above a bear trend line. And the stronger the rally is, the more likely not only will it have a second leg up, but it will have a third leg up. And this is strong enough so that it's likely to have a second leg up, a second leg sideways to up. And this is, we have a sell-off, a little bit of a bounce. This meets the minimum expectation of the bulls. It's the second leg so far sideways. The bulls hope it's up, but 2 consecutive bear bars, we may have to go sideways more before we can get one more leg up. And the bulls need to do more before traders will conclude that this bull trend will last all day. Look at this. We have a reversal down, and we fell below the breakout point. Okay, that's the breakout point. Okay, we fell below the breakout point, but a lot of institutions trade line charts, and you can see we pulled back below the breakout point, but a line chart is based on closes, and the highest close in the breakout point is here, and the lowest close in the pullback is here. So there's a space between that lowest close and this red line. So on a line chart, there's a gap. See, there's a gap between that pullback low and this breakout point. So a gap on the line chart, but not a gap on the candlestick chart. So there's a gap basically between the bodies, and I call that a body gap. It's still a sign of strong bulls, but it's not nearly as strong as an actual gap. And if the market gets 2 or more gaps or body gaps, the odds are 80% that you're not going to get a bear trend for the remainder of the day. And we don't have that yet. So the bears still have better than a 20% chance that will trend down for a couple hours at some point. Is it 50% chance? No, right now we're in a bull reversal. It's a small pullback bull trend, and the bulls are hoping it'll last for many hours. But the bars are not big. They're not breaking far above the breakout point. Now it's 5 bars, so there's not a lot of bullishness yet. If you had to be in the market right now, what would you do? You'd be long. There's nothing to short yet. Now, the bulls who bought above 8 or 9 or 12, above 15 or 16, or above 27, they're still long, right? They may have exited below, the bulls who bought here may have exited below this because we have a double top, or this, we have another double top. So it's reasonable to have exited longs here, but the bears did not get a strong sell signal, and therefore the bulls would look to buy again above the bull bar closing at its high. So the bulls would buy above here or above here. So right now we're still on a buy signal. So if you absolutely wanted to be in the market all day or most of the day, right now you'd be long. And if you're flat and you're wondering, should you buy? It's okay to be long, but would you buy a full-size position? I would not. The probability is just not high enough yet. So if I'm buying here, I would be buying a small position, and I'd put a stop below the bottom of the bull trend. If we got a second sell signal bar or a bear bar closing near its low, and then the market went below that, I would get out before my stop was hit. So the bulls have bought above here or here, they're still long. Stop below the bottom of the most recent major bottom. This is a major bottom. We have strong bull bars, and we broke through a new high. And so a lot of bulls have stops right below here, right below 26. If you're flat, you could buy a small position at the market, 20% of your normal size, and put a stop below that. Or you can wait for a second buy signal. We have one here. Maybe we'll go sideways and get a small double bottom and another good bull bar. Then you could buy over here, looking for a test of Friday's high, maybe last week. Nothing to short yet. A lot of sideways bars here, We're getting more here. And then we have a big move up, a big move down, a big move up, very reversal. We're getting a lot of brief legs up and down. That's trading range behavior. And the more you get of that, the more likely the day will continue to have a lot of trading range behavior. Even if it has a trend, you know, a brief trend down, a trend up. Right now, the odds only 40% that we're going to have a big trend today. The bears are hoping that this whole thing is a lower high double top with this. They're hoping this is a bear trend from here to here. And this is a pullback, and then we get another leg down. But there's no reason to be short yet. And there's not much of a reason to be long. On the open, you would not buy above 1. If it was a big bull bar down here, you could buy above the first bull bar of the day. But if you're near the moving average, near yesterday's close, or in the middle of something, in general, it's better to wait until you see consecutive bull bars with at least one being big and closing near its high, and then buy above the second bar. And you see what happened on 3? Instead of going above 2, which would have been a buy signal for a lot of people, the market reversed. And we had 3. We have a small double top, 81 and 2. 3 is a bad sell signal bar. However, once we had consecutive bear bars, with one being big and closing near its low, traders went short, so they sold below 4. And on the open, no matter how strong a move up or down is, 50% chance it's the wrong way and it's going to fail and the market will reverse. So at the close of 2, 50% chance the market was not going to go above 2 and continue up. Instead, it would go down. So some bears sold as soon as 2 closed. They sold. Look at the high and close. Look at the high and open of 3. The market sold off immediately at the close of 2. That's because the math was great for the bears. They knew that if it went above 2, it would be a buy signal. And if they sold the market at the close of 2, placed an order to buy 1 tick above 2, the risk would be very small, and they might capture a swing down. And that's what happened there. Cup and handle. I'm going to turn off the screen for a second because I mentioned cup and handle, so I'm going to open up my encyclopedia to show what I was talking about with cup and handles. Okay, these are slides from my encyclopedia. Every day I find patterns that took place during the day and I file them away. So cup and handle up. Currently have 25 examples of it. So if you have a sell-off and a reversal, traders see that as a cup, and then a pullback from the reversal, that's the handle, and they look for a bull trend. This is kind of a perfect one. The bull's gotten about a measure move up. We have a breakout above this, more than a measure move up from above this, and we're about a measure move up from this breakout. And if there was a higher low over here, it's often a head and shoulders bottom, which this was. So in addition to a cup and handle, it was a head and shoulders bottom. The sell-off and reversal up forms the cup. The pullback from the breakout forms the handle. Traders look for at least a measure move up. We've got a breakout, look for a measure move up. We have another breakout, so traders will look for a measure move up from that breakout point. Sell climax, reversal up, very similar to today. And we went up about a measure move. Big sell-off, big reversal up, and then a pullback and rally. We barely went above the top of the sell-off. We ran out of time. We had a lot of time sideways. And what else do you notice here? A lot of bars with big tails. That means every one of those tails, the market went up and down, or it went down and up. So a lot of uncertainty, and that increased the chances that we would have a lot of sideways trading. Sell off, strong reversal up, forming a cup, and then the handle, and we rallied for a couple hours, but did not go very far. Sell off, strong reversal up, sideways for 2 or 3 hours, forming a handle, and then we had another leg up. A brief sell-off, big reversal up, sideways for 20 bars, and then we had another leg up. Brief sell-off, brief reversal up, just 3 bars, sideways for 15 bars, another leg up, but did not last. Another cup and handle, did not go very far. The bulls wanted a cup and handle, but they got a bunch of them. So big reversal, the pullback is too deep. We got another reversal, pullback failed to go very far up. For the bears, we have a cup and handle top, a big sell-off, rally, a pullback, did not go very far. Trading range, just lots of reversals, and the more reversals you get, even if the legs up and down are big, the more likely you're going to have a lot of confusion in the sideways market. Cup and handle, and didn't go up at all. It just became a big trading range. Sell-off, reversal, did not go all the way to the top of the sell-off, but a cup and handle, and it failed. It led to a sell-off. Sometimes a cup and handle is just a couple bars. So down and up and then pull back. And the bulls got a rally for about 20 bars, and then it failed ultimately. But the bulls did get a 20-bar bull trend. Similar to today. Big sell-off, big rally. It took a while before the bulls got their next leg up. These are failed and down. Sell-off, reversal up, handle, it failed. Any pattern is going to fail at least 40% of the time. And that includes cup and handle patterns, head and shoulder bottoms. So reversal up, a pullback. Instead of going up, it failed. We got a double top, bear flag, and bear trend. Sell off, reversal up, a handle, went up for just a little bit, and then failed. We're forming another pullback, a breakout, and I'm leaving this red line here. Why would I do that? Because of this line chart. We still have a gap between the pullback and the breakout point. But if we get a close below that red line, then the gap closes. And if the gap closes on the line chart, it greatly reduces the chances of the bull trend continuing. So I always pay attention. If I see gaps and body gaps, I pay attention to whether or not they close. And the bears want a bar to close below that red line. And the bulls are buying every time it gets there because they know the importance of that red line. They're trying to keep a gap open on the line chart. There's the line chart. And if we get a close below that red line, then this black line will be below that red line. And traders will see this as much less bullish. It's already not particularly bullish. It's just not. You know, look at the past 20 bars. When you look at this, you say, wow, what a great bull trend. Or do you say, yeah, it's a trading range. We broke out, we had bad follow through, and we continue to get bad follow through. So this is not, you know, when you look at the most recent 20 bars, it's not that bullish. You can say, well, go back 30 bars and look at that. But, you know, traders are always thinking, you know, what have you done for me lately? And lately, it's not bullish. The further something is to the left, the less important it becomes. And this is really bad for the bulls. Why is this bar getting bigger? Because a lot of bulls see this as a breakout that is failing. Not a good sell signal bar, 30, 33, 35, but nobody's buying, so bulls are starting to give up. If enough of them give up, we'll get a close below the red line, and we could even get a bear breakout bar. A big bear bar closing near its low, closing below the low of the prior bar, and closing above some other support. So the bears are trying to get a breakout below this trading range. This is the lowest point in that trading range. In a smaller time frame, this is a triangle. Now, what else could you view this as? Well, you could view it as a double top and a breakout that failed, a trading range breakout that failed. But when you have a bad signal bar, it reduces the chances that the trend will go very far. Look at the reversal down below 3, a bad sell signal bar, big tail below. We get a good bar for the bears here, but the initial bar was bad. Look at the bottom, 7, a bad buy signal bar, 8 and 9, prominent tails, a doji bar, not a very good buy signal bar. And then up here, sell signal bar 19, but tail, weak entry bar, another sell signal bar over here, weak. Sell signal bar 30, weak, 33, 35. We're getting bad buy and sell signal bars. That happens much more often in a trading range than in a trend. So that is further evidence that today is probably not going to be a strong trend day. This is what the bulls want. A bull bar closing near its high. Big sell-off, 60 or 70% chance of a second leg down. You could buy here. If you do buy above that bull bar, would you put your stop here? Most traders, yes, but experienced traders, no. An experienced trader would look at this and take a small buy here and buy more here. So if it breaks below this, they would buy more, and then the bear breakout would fail. So many traders believed that the market was not going to go down much further that they started to place limit orders to buy well above this, maybe a 50% retracement of that. And anything bearish and bear bar closing near its low, a lot of bulls bought. And then you get another buy signal bar here, a higher low double bottom. This is a pretty good one, only a small tail and a big body. This is a better one, a bull bar closing near its high. And then another bull bar, big bull bars closing near their highs. This is probably going up. So this is very bullish, very good bull bars, big bull bars closing near their highs, multiple bull bars. Compare that to today. We don't have that today. So today is much less bullish. And it's much less likely that we're going to do this. It could change. We could start getting bars like that at any time, but we don't have them yet. We're still on the buy signal above 27, even though we dipped below the 27 high here. We did not get strong sell signal bars, so nothing to sell. And we did not break below the bottom of the bull trend. And then look at the close of 36. It did not close below that red line. So the bulls were able to overwhelm the bears, at least enough to prevent the body gap from closing. So on the line chart, there's still a gap. Line chart bar 36, we still have a gap between this pullback and that breakout point. Sometimes you can see we're below the red line now, but the bar has not closed. So when this bar closes, if it closes above that red line, we'll still have a gap. Bears want a bar to have a bear body and close at least one tick below that red line. And then you'll get more bulls giving up and more bears selling, and we could end up with a swing down. If you're a bull, I would get out below a bear bar closing below its midpoint, not a little bear bar, but a normal sized bear bar. Or I would get out the size of a scalp below the low of any bar, bull or bear bar. Or I would get out below the bottom of the most recent major higher low. The major higher low is a strong leg up, breaking to a new high. Since these bulls are still long, you could buy at the market and use those exits that I just said. But if you do, I would buy small. This is not strongly bullish. This is a very weak bull trend. And if it starts to become stronger, you can buy more. If it goes up the size of a scalp, then you get another bull bar closing near its high, you can buy more. And then if it goes up the size of a scalp or more, and you get another bicycle bar, you buy more. Now, if it goes below 26, a lot of bulls will exit. But a lot of other bulls will buy, betting that we're in a trading range, and anytime you break above, you should sell and sell more higher. Anytime you break below, you should buy and buy more lower. I do that pretty regularly if I think the market's in a trading range. A day like this, I will buy at that low and buy the size of a scalp below it. If I buy at this low and I get filled and it goes up, I make my scalp. If I buy at this low and it goes down to the size of a scalp, I buy more. And then it reverses up to my first buy. I can get out, break even on my first buy with a profit on my lower buy. Or I can hold both long, hoping that it goes up the size of a scalp above my first buy. And then I make the size of a scalp on my first buy and 2 times the size of a scalp on my second buy. If it goes above a prior high, I sell. Above the prior high, I sell. Sell more the size of a scalp higher. Buy more the size of a scalp lower. It sounds easy, but you cannot do it if you have a small account because you'll panic out. You're so concerned about loss. Okay, this is another buy signal. So bulls were flat. Just check. I'm wrong about, yeah. That's a 3-minute chart. I'll go a 5-minute chart. Bulls who are flat could buy above 37 and put a stop below 36, hoping for another leg up. 1, pull back, 2, pull back, 3. There's no reason to be short here. Because of the low probability, if you buy, I would trade small, like 20% of your normal position. And if the market keeps going up, you can buy more. The bears are going to try to get a double top with here or here or here. And the bulls are hoping that we've adequately tested the highest close in the breakout point and that the bull trend is resuming. Remember over here, I said we probably would have to go sideways more before we can go up. Now, what happens if 38 closes near its low? That would be the first credible sell signal since the reversal up here. And you will get bears selling. Can you sell on a stop 1 tick below 36? If you're long, it's reasonable to sell out of longs. But if you're flat, I would not go short. What happens if 38 closes outside down, which is, it's outside down now. We went above the high of that, we went below it. We're still on the long with a stop below 36. But if 38 closes near its low, I personally would not short. I would like to see one or two closes below 36, or at least a close below that red line. You can see the market's paying a lot of attention to it. We touched it here, we touched it there, here. So we've had 6 bars testing the 18 close. And the bulls, every time, have been able to get the market to close above the red line. But at some point, they'll give up. They'll stop trying. If they can't get the market to rally, they'll give up and we'll close below the red line. More bulls will give up after that happens, and more bears will start to sell. This is potentially a very good bar for the bulls. If 38 closes near its high and above 37, you'll get more bulls buying. They'll conclude that we went upside down, the bears failed. We tested this close many times, and every time the bulls won. Here, the bears tried to do something bearish upside down. They tried to close below the red line. If they fail, and if the bulls are strong enough to get 38 to close near its high, at or above the high of 37, it's another buy signal. You'll get more bulls buying. It's reasonable to take that buy. Okay, not bullish enough. We're still on the buy above 37, but not bullish enough. At some point, the bulls are going to give up. If we keep going sideways, they're going to give up. We'll break strongly to the downside. They have not given up yet. At some point, the bears will give up. 6 times they've broken below the red line, and they've been unable to close below it. They've been unable to close far below it. And if the bears give up, what happens? You get a bar that looks like that. So right now, we're deciding, are we going to get the bear breakout or the bull breakout? It's still slightly more likely that we'll get the bull breakout. But if we get a close below that red line, the bulls will give up below that bear bar. And the bears will short. And then we'll come down and test the bottom of this leg up. Reversals are trading range behavior. Prominent tails are trading range behavior. Overlapping bars, 3 or 4 or 5 overlapping bars, where the bar overlaps 50% of the prior bar. Trading range behavior. And today has been mostly trading range behavior. Now we had a brief trend up, a trend down, a trend up. But most of the bars have been trading range bars in a sideways market. It reduces the chances that there will be a big trend today. We're in a bull trend now, but it's not very strong. Look at this. Bar 39, 81 bars to the day. The midpoint is 40 or 41. The market often tries to reverse around the middle of the day. So whatever it's been doing, it often tries to go in the opposite direction. If it's sideways, it often tries to break out. So we're in a window when the market often does something, breaks out or reverses. Very often it reverses exactly at 40 or 41. Friday, 37, and then 41, 42, we get the reversal. A lot of times it'll try to reverse here at 43, and the reversal doesn't get very far. Sometimes it just pulls back and then the trend continues. I don't have numbers over here. Middle of the day, always look for the market to do something different. If it's been going up, look for it to go down. If it's been going down, look for it to go up. If it's been going sideways, look for it to break out. That doesn't happen every day, but it happens frequently. So you have to be aware of the day. Today is the first day of the week, so today's open is the open of the day. Today is the first day of the month. So it's also the open of the month. And the open of the month, I keep a line at the open of the month for the entire month. Because if the current price is above the open of the month, then we have a bull body on the monthly chart. If the current price is below the open of the month, then we have a bear body on the monthly chart. And traders pay attention to that. 7 bars have now fallen below that breakout point on the line chart. So the more bars that get that test that line, the more neutral the market becomes. If the market breaks above and pulls back, it's bullish. Pulls back 2 or 3 times, still bullish. But the more sideways bars and the more times it tests, the more it becomes 50-50. Just went below the outside down bar. So more and more bulls are giving up. Okay. We closed below the highest bull close in the breakout point. So in a line chart, we've closed the gap. Okay. You can see there's no longer a gap between the lows here and the breakout point here. So this is significantly less bullish than it was. Why is this blue line far above this? Because this blue line is based upon the candlestick chart, and the black line is based upon the closes on the candlestick chart. So when I go back to the candlestick chart, you'll see that there's actually a tail up here. See? Is this a bear breakout bar? Remember I said a bear breakout bar is a big bear bar closing near its low and below the low of the prior bar. This is a big bear bar. It's closing below the low of the prior bar, but it's really not closing near its low. So it's a borderline bear breakout bar, not very bearish. The bulls are hoping that this bear breakout fails, just like the bears got the bull breakout to fail. Now, are the bulls still long if they bought above 27, 28, 32, 37? Yeah, they're still long. We have not traded below a bear bar closing below its midpoint. We have not traded below a major higher low. We have not fallen. Well, I guess we did fall the size of a scalp low, 30. With 36 is 22 ticks, more than 22 ticks below. But I would still be long. If it starts to go up, you can buy more. The bulls are hoping 39 is just a bear trap. It closed the gap, so that there's no longer an open body gap, but it's immediately reversing up. Did you buy at the market? Sure. The most recent signal has been a buy signal, so it's okay to be long, but it's not very bullish at the moment. If you do buy small. A second close below the red line, but a bull body. So not very bearish. Consecutive closes below a breakout point, but not consecutive bear closes below the breakout point. Here we have a breakout. That's the breakout point. We have consecutive bull bars closing above the breakout point. The breakout bar closed far above the breakout point. So this is a strong breakout. 70% chance you're going to get some kind of a measure move up. 70% chance you get a second leg up. Here, we're still deciding. It's slightly more bullish than bearish, but not much. The bears do not have a sell signal yet. If I had to buy or sell at this instant, the most recent signal is a buy signal, so I would buy, trade small. The more bars you get in a tight trading range, the more neutral it becomes. And right now it's almost 50-50 that we'll get a bull breakout or a bear breakout. a successful bull breakout or a successful bear breakout. It's slightly more bullish. I want to talk about the bond market for a minute. Bond chart, monthly bond chart. When we did this, at the time we were doing this, I said this was probably going to be the high in bond prices for the next 20 years. And that we probably will never see bond prices this high again. You know, the interest rates are almost zero up here. That is very abnormal. And this blue line is 100, exactly 100, so you can call it par. We had a big reversal down, and par is a really important price. It's the most major big round number there is in the bond market. We've been close to it now for about 20 bars, 20 months. I think we're going below par. You know, we may go more sideways, we may go up. You know, we may go up here over the next few years and then go below par, but I think we're going below par. And bond prices are the exact opposite of interest rates. So that means I think interest rates are going to go substantially higher. Long-term interest rates are going substantially higher. And I think that we'll probably be around par or below par. Once we get below it, I think it'll last at least 10 years. So we're going to have at least 10 years of higher interest rates. Next target would be that low or here. So bond prices, I think are going to go into the 90s at some point in the next few years. As I said, we've been sideways for 15, 20 months right now. Very oversold. We could get a second leg up. The bulls are hoping that this is the first leg up, and we have a pullback, and then we get another leg up. The bears are hoping we've already had 2 legs up, and we're going to resume down. I don't know yet. I think it's 50-50 that we go up here and then down, 50-50 that we just go down. But I think we're going to go below par. And I think it's going to have a dramatic effect on the economy and on the stock market. Bad effect. Breaking out, bears are giving up. Bulls are buying as it's going up. We're back above the 36 buy signal bar, so you get more bulls buying. We broke above the outside up bar, 37. We broke above the high of the day, 30. So all are reasons for bulls to buy. So they're buying at the market, they're buying the stops. Breakout bar, a big bull bar closing near its high, above the high of the prior bar, and it closed above another significant high. The bears are hoping this is a wedge, 1, 2, and 3. And the bulls are hoping that we're going to go up to yesterday's high. Yesterday is the day to the left of this dotted line. If today's a Monday, yesterday's a Friday. So when I use the term yesterday, I talk about trading days, not calendar days. Breakout 29, bear bar 30. Breakout 41, the bears want bear bar 42. Wedge top 1, 2, 3. 42 is important. The more bullish it is, the more it looks like this, the more likely it will go up. The more bearish it is, the more likely 41 will be a bull trap, trapping bulls into a bad long, and that will reverse down. So this is a really important bar. Can you be short right here? I would not be. The math is good for the bears, but it's hard to manage the trade. So it's reasonable to sell the market and maybe put a stop the size of a scalp above 41. And then if 42 is not bearish, you get out with a small loss around break even. If it is bearish, you hold short and you hope that we swing down for the next couple of hours. And if it does go down, you'll make many times the size of your risk. You risk the size of a scalp, 5 points, but you can make 20 or 30 points on the reversal down. So the math is good. What's the probability? Right now, maybe 40% chance that this is going to reverse down. 60% chance will go up. But the more bearish 42 is, the more it becomes 50-50. And the reason why 42 looks like that is you do have a lot of bears selling the close, betting the breakout will fail. And you had bulls who bought above 40, above the breakout point, 40 over here, above a new high, but they're not buying higher. So the bulls, they bought once, but they're not continuing to buy, at least not yet. Everybody's waiting to see what the follow-through bar will be. 42 is following the 41 bull breakout. Is it going to confirm the breakout? Is it going to have a bull body like 57? Or is it going to fail? Yesterday, 42, 43, 44, strong bull breakout above a bear trend line. 45, a sell signal bar for a failed breakout. But when a reversal is this strong, 60 to 70% chance you're going to get a second leg up. And therefore, more traders bought the 45 low and sold. Now, how bullish can this be? Can the bulls get a second bull bar that looks like 41? If they do, then we'll go a lot higher. If they do not, then we might not go higher at all. Can the bears get a bear bar closing near its low? If they do, a lot of bears will sell below that bar. A lot of bulls will sell out of longs. What happens if it's a bear bar but not big, and if it has a prominent tail below? Most bulls will hold long, and most bears will not short. Whenever you feel like you're waiting for something to happen, that's trading range behavior. You want more information, and you want more information because you are uncertain. And uncertainty means trading range. There was a lot of uncertainty here. Nobody wanted to sell low. Nobody wanted to buy high. So if there's a big bear bar, instead of selling, they bought. If there's a big bull bar, instead of buying, they sold. So 42 is a very important bar. Can it be very bearish? Can it be very bullish? It looks like it's going to be a little bearish, but not very bearish. Okay? So should you sell out of your longs below 42? I would not. If you get a bear bar and it's not very bearish like that, a lot of traders will wait to see if we get a second bear bar before making a decision. So that's not very bearish, but it's also bad for the bulls. So bad follow through so far. So bullish, but not very bullish. Bulls right now, they could get off the size of a scalp below 42, but that's down here. It makes more sense just to risk a little bit more and maybe get out below 36 or 39. That gold dot is bar 40. Remember I said the market often tries to reverse or break out around the middle of the day, 40, 41. And we're trying to break out, but the bears are trying to get it to reverse. Can you buy at the market? Yeah, we're still on the buy signals from here and here. Bears have not done enough yet. Most traders are not going to short below 42. Here, 3 legs up, a bear bar, big bear bar, but a prominent tail. A lot of traders will wait for 2 bear bars before selling, or they'll wait for 3 bear bars before selling. For 3 bear bars before selling. Sometimes when you have a breakout, the follow through does not come on the next bar. Sometimes it comes 2 or 3 bars later. And right now it's coming 2 bars after the breakout. Who's buying up here? The institutions, when they think the market is on a buy, they buy repeatedly. That's how you can just keep going up and up and up. It's not like one institution bought here and then one did not buy and then he bought up here. No, it's the same institutions. And if the market is going their way, they add to their position, which means that their initial position is not a maximum size. So they trade small and add on. You can see 42, it's a pullback from the breakout, but it's a bear bar, so it's a bad buy signal bar. It reduces the number of bulls willing to buy above 42. 41, big enough to expect at least a small second leg up, 60% chance. It's possible 43 is all the bulls get. It's a second leg up. And sometimes the second leg up is just one bar. A lot of bull bars probably going to get a second leg up. Well, it's just one bar. Traders are watching for evidence of a strong bull or bear trend. We're in a bull trend now since the low of the day. It's a bull channel. We have a breakout and channel. But when you have a channel, the market often gets profit takers on the third leg up. So 1, pull back 2, pull back 3. So there are bulls taking profits here. Bears, no bulls will take profits there. So you're getting some bears selling. Most traders better to not sell yet. I said bulls might buy one tick above the prior high, 31, but you'll also get bears selling. When 29 broke above 19, some bears sold and they were willing to sell more higher. They needed it to fall 21 ticks below 19 to make money, and it did. 36 is at least 21 ticks below 19, so the bears are sold here, took profits here, and that's part of the reason we reversed here. You had bears buying back shorts. Same thing here. You had bears selling with a limit order at the 30 high, betting that the bull channel is weak, and we probably would get a pullback before we go much higher. You can do that if you have a big account, and you can use wide stops and scale in, but most traders should not be doing that. They should just be looking for stop order trades, buying with stops or selling with stops. Hesitation. It's not as bullish as the bulls want. We're in a bull trend. We're in a bull channel. We have higher highs and higher lows. So the odds favor higher prices, but it's not like 70%. It's just not all that bullish. We're getting breakouts with bad follow through. We're having a lot of reversals, a lot of bars with prominent tails, a lot of time sideways. That all reduces the chances of a big bull trend day. It can change, and we can start to do this at any time, but we have not done that yet, so it's not nearly as bullish as it could be. Here, the bull trend lasted most of the day, even though it was sideways for an hour here and sideways for a couple hours here. The pullbacks were small. The pullbacks here were much smaller than the pullbacks today. And therefore, this is much more bullish. I was in the chat room here, and I repeatedly said, you cannot sell, you can only buy. Until the bears start to get bigger pullbacks, you can only buy, because it's a small pullback bull trend and it could last all day. We have important magnets above, and we're in a bull trend, but are the bulls strong enough to break above yesterday's high, Friday's high? And are they strong enough to break above last week's high? Now, I said earlier that I thought there was only a 40% chance we would get above last week's high. I still think there's only a 40% chance. But if we get 2 or 3 strong bull bars, it would be 50 or 60% chance. So right now, I think there's a 60% chance we're going to stop going up and either go sideways or down before we get above last week's high. It's just not very bullish. Stop going up and either go sideways or down before we get above last week's high. It's just not very bullish. I'm going to turn the screen off for a moment. I'm going to open the slide. PowerPoint. The market often has a breakout and then forms a channel. A breakout and then a channel. A breakout and a channel. If the channel is tight, the pullbacks are small, the bull trend is strong, and it can last all day. A breakout and then a channel. Pullbacks, pullbacks, pullbacks. Very tight channel, small pullbacks. It can last all day. But other times you have a breakout and the pullbacks are bigger. It reduces the chance that the channel will last all day. So 1, 2, 3, and then we came up and did a double top. So today is similar to this day. The pullbacks are bigger and it reduces the chances that the trend will last all day. Breakout, but a very deep pullback. So bulls are not all that strong. We got 3 legs up and then some profit taking. Breakout, very strong, reversal down, 3 or 4 legs up. The trend did not last all day. And today it's probably not going to last all day unless it becomes stronger. Breakout, pullback. It did last all day, but it was a weak trend and with a lot of sideways trading. So trending trading ranges, a trading range, and then higher, and then another trading range. Small pullbacks, they can last all day. The bulls are so eager to buy, the pullbacks are never very big. A lot of sideways trading. We lasted all day, but did not go very far up. This is similar to today. We lasted all day, but did not go very far up. This is similar to today. Similar to today. Sell-off, rally, and channel, but did not last all day. 3 legs up and a channel, so it's a wedge. So 1 or 1, 2, 3. I would say this is 1, and then sideways 2, sideways 3. And if we get a bear bar closing near its low, it's reasonable to exit longs. If 45 is a bear bar but does not close near its low, I would hold long and get out the size of a scalp over 45. Now, what else do you notice about 45? Well, the low of 45 is above the low of 44. The low of 44 is above the low of 43. That started here, 39. So 7 bars where every low is at or above the low of the prior bar. So a 7-bar bull microchannel. That's a sign of reasonable buying, strong bulls. If 45 closes below its midpoint, especially if it closes near its low, I think you should get out. You can always buy again if 46 or 47 is a bull bar closing near its high. But we have a wedge, we have a lot of trading range trading, and second leg up, 41 pullback, and then second leg up. The bulls are trying to get above yesterday's high at a minimum. They really want to get above last week's high. Bull microchannel is a small pullback bull trend. The pullbacks are so small, they do not even go below the low of the prior bar. You have to get out below 45 if it's a bear bar closing near its low. No, I don't think you have to get out. I think you can stay long, stop below 39, or to stop the size of a scalp below 45, like 22 ticks. It has to go 22 ticks below 45 for the bears to make money if they sell 1 tick below 45. But Right now, I think we're gonna get closer to yesterday's high. So I'm not looking to short yet. If we get surprisingly big bear bar closing there slow, if we get a bar that looks like that, that means there's very aggressive selling. I would sell. If we get 2 or 3 small bear bars closing near the lows, that would be sustained selling, and I would sell and it would get out of balance. But let's see what we get. If you exit below 45, that's reasonable. A big bear bar closing near its low. Then let's say 46 or 47 is the bull bar closing near its high. You buy again. So it's reasonable to exit below 46. It's also reasonable to exit the size of a scalp below 40. Reasonable to exit below 45. Reasonable to exit the size of a scalp below 44. Reasonable to exit below 36. I would not short below 45 despite the wedge, because the 6-bar bull micro channel magnet just a little bit higher. So I'd wait for more signs of strength in the bears. You can see there are, at least right now, as many bulls buying the market as there are bears selling. The bulls are buying because they know a lot of bulls will exit below 45, and therefore they do not want the market to go below 45, so they're buying the close of 45. If you are an institutional computer, it's a reasonable buy, right? People's opinion about the bull trend will change if it goes below a bear bar closing near its low and we're in a wedge bull channel. And you don't want their opinion to change. You want it to continue to be bullish. So anytime the market does something bearish, you're going to buy instead of sell because you don't want the bearish thing to trigger. Do I think we're going below 45? I do. We have a wedge. We have a weak bull trend. We have a lot of trading range trading. So I think the uncertainty will continue. If 43 went below 42, that would be one sell signal. And then this would be a second sell signal. And I think a lot of traders would short below 45. But because the first sell signal below 42 did not trigger, this then is the first sell signal. And most traders will not take it. So you can see we dipped below 45 and there were more buyers than sellers. It's just not bearish enough for most traders to sell. But if we get more bearish things, like a second bear bar, a second big bear bar closing near its low, you'll get more traders selling below 46. What do you do here? Reasonable for bulls to get out below 40. 5 or below 46. But I think it's not yet bearish enough to sell. And if we get a bull bar, maybe 47 or 48, the bulls can always buy again. And for the bears, the height of this pullback is about the height of that, about the height of that. And I think selling too low in a bull channel is a losing strategy. What do the bulls do if they did exit below 45? I don't think it's a good enough sell signal. So I think we're still on the buy signal, but I think it's not particularly bullish. The bulls will buy again if we get another reasonable buy signal. In other words, another bull bar closing near its high. Over here, I talked about how we had a breakout and a couple of bear bars. I thought we'd go sideways for 5 or 10 bars, and we may do the same here. For the bulls, it's a double bottom. We're down on 42, down on 47, so a double bottom bull flag. Did not quite reach the moving average. Here we fell below the moving average. Here we fell below the moving average. And here we did not. and 47 is a bad buy signal bar. So probably more sellers than buyers at and above 47. I would not buy above 47. So the bulls, I think they're either long, stop below 39 or below 36, or 22 ticks below 44, or they're flat. And the bears, some bears are short here, but I would wait. I personally would not take the short. A 6-bar bull micro channel, first reversal down, not bearish enough. I talked about the bond market, saying that I'll put up the bond market, saying that I think we're going to be below par and be either at or below par for 5 years or more. We may go up more first. And I don't think it has anything to do with Biden or Trump. I think, this was just a blow off top in a bull trend that lasted 30 years, 40 years. And I think it's a technical thing. And I think, this is the first leg down. So even if we go up, I think we're going to have a second leg down. So I think we're going to be in the 90s at some point. I suspect it'll probably be in the next few years, but we may go up here or here and then go down. But I think interest rates are going a lot higher. If you're not, if you're under the age of 50, you don't know what it means to have, high interest rates. But I think you're going to find out. Everything becomes more expensive. And again, I don't blame Congress. I don't blame the presidents. I think it's, largely a technical thing. The blow off was because Powell was an idiot. All during this time, I kept saying, he's a fool to keep interest rates low and to keep basically buying government debt. I said it was a terrible mistake, and that just exacerbated the rate of the reversal. If he didn't do that, we would still probably be here, but would have been rolling over instead of a dramatic rise in bonds and a dramatic sell-off. So, the reason why we fell so sharply, I think, is because Powell was foolish. He didn't know what he was doing. I think Powell has learned on the job. So I think he's probably an average quality Fed chair. But back here, I complain all the time, saying the guy's a fool. He doesn't know what he's doing. Now, market's saying prices are getting stable, so he does know what he's doing. So I'm not opposed to Powell now, but I was very much opposed to him here. I'm an eye surgeon, I'm not an economist. So, I could be entirely wrong about what I'm saying, but I believe I'm right. More traders sold above 47 than bought. It's a pullback in a bull trend, having higher highs and higher lows, but it's a bear bar. We have a wedge, 1, 2, 3. Traders expect 2 legs down, so they'll sell first reversal up. And it did not quite reach the average price. So traders felt that the market had to test the average price before they were willing to buy. Another problem, I talked about how the body gap closed there. Well, there's another body gap here. Breakout, the highest close is here, and 48 closed below it. So I said that if the market forms 2 or more gaps, or body gaps in a bull trend, you're probably not going to get a bear trend all day for the rest of the day. You're probably going to get a bull trend for the rest of the day. And here, body gaps have closed twice. So chances are this is not going to last all day. So let's say we rally up to bar 60 I would start looking for a reversal down into the close. So even if we go up for another hour or so, chances are we're going to get some kind of a reversal before the end of the day. So one more leg up, maybe a double top here, maybe a higher high here. Maybe we have a breakout and then a second breakout. So the count started over again. So instead of the wedge being 1, 2, 3, and maybe 1, and then a new 1, 2, and 3. But I don't think we're going to go a lot higher. I'm sorry, I'm clicking the microphone on and off, but sometimes it's not reversing. But anyway, what I was saying is limit order bears are making money. They sold at this price, they went down, they made money. They sold at this price, it fell at least 21 ticks below their entry, so they could make 20 ticks profit. They sold here, and they sold more 20 ticks higher, and it's back below their first sell. They could get out break even on their first sell with a profit on their second sell. So they sold here, they sold 20 points higher, or more than 21 ticks below, they could get out. Barely touched the moving average, but 3 of the past 4 bars have bear bodies. So is that average or below average? It's below average bullishness. So we probably have to go more sideways to down before bulls will buy. We barely touched the average price and we bounced. But most of the recent bars are bear bars, 3 out of 4. So traders do not want to pay an above average price unless they're buying bars that are above average in bullishness. And 3 out of 4 bars being bear bars, that's just not bullish enough. The bears are hoping this is a wedge top and we've begun a swing down. The bulls are hoping that it's a second leg up, 1 pullback, 2 pullback, 3, and that we get up to yesterday's high before we get any significant reversal. It's still slightly more bullish than bearish. But body gaps twice closed today. So chances are the bull trend is not going to last. The question is, have we seen the high of the day, or do we go up a little bit more and that becomes the high of the day? And we don't know yet. Bears getting a lot of opportunity to sell 1 tick below 45. So if you're a bear and you're thinking, gosh, I wish I sold below 45, well, they went back above that 45 low in each of the next 4 bars. So you've had lots of opportunity to sell. And usually if the market makes it easy to do something, it's the wrong thing. So it's easier to sell at that 45 low. That reduces the chances that that it's a good sell. Usually if the market is going to do something, it doesn't give you a lot of opportunity to enter at the best price. And if you do have a lot of opportunity to enter at the best price, the market's probably not going to do what you hoped it would do. If it's hesitating and giving you a lot of opportunity to sell, that means it's not nearly as bearish as it could be. This is bearish. If you did not sell below 4 and you hope for a pullback, you missed the whole trade. Best trades do not give you a lot of time to enter late. The market's deciding this was strong enough up to have 2 more legs up, 1, 2. But this is strong enough up to have at least 1 more leg up. It might be strong enough up to have 2 more legs up. So it might be 1 pullback, 2 pullback, 3. Plus we have this magnet here. So, and I don't think this is a strong enough sell signal. So I still think the odds are we're going to at least test the 45 high, maybe test yesterday's high. Bad buy above 47. A lot of bulls will wait for the bull bar closing there its high. I personally would prefer the pullbacks to be deeper below the moving average and then get a reversal up. I want the market to be more oversold Whenever you barely touch the moving average and resume up, it reduces the chances that the buy will be successful, unless the bull trend is extremely strong. And this is not extremely strong. So buying above 50, even if it closes near its high, is less certain. When things are less certain, the probability is less. And to make the trader's equation better, you have to reduce your risk. So usually if you have a buy signal that's not as strong as you want, it's better to buy a small position, like 20% of your normal position. And then if it goes your way, you buy more every time there's another buy signal. And if it reverses on you, you do not lose very much. Back to waiting, right? And that is a sign of trading range trading. And it increases the chances that we'll probably have to go more sideways than up. I think it's not worth being short. Let's say 50 closes near its high and you sold below 45. I would exit shorts. You can always sell again if we break strongly into the downside. And for the bulls, if they did exit below 45, they'll want 50 to close very close to its high before buying again. Reasonable to be flat here. We have the first credible sell signal since the bull trend began. So it's reasonable to be out of longs. And if we get a buy signal at 50, it's really not all that strong. We only dipped a little bit below the moving average, yet the bull trend from here to here, it's not very bullish. So you don't want to, you just hope to be able to buy further below the moving average. You don't want it to just come down to average and resume up when it's not all that bullish. So if you buy above 60, I would trade small. This is not a high probability buy. Can the bears sell above 60? Is it 60, 50? Can the bears sell at the 50 high? Arguing we're still on the sell below 50, 45, I would not. But if I did sell below 45, this is a second reversal up above 47, above 50. So if I'm a bear, I would exit above 50. And for the bulls, I personally would not buy above 50. I think we have to get further below the average price. This is average behavior, and we barely went below average price. So I think we have to go either sideways more bars or down more. The bulls are concerned. It's not bullish enough. We did not test the average price well enough. So a lot of the bulls are hesitant to buy, and we did not go above 50. I think we have to get lower. The bears are hoping it's the high of the day, that the midday reversal is going to lead to a bear trend. Bulls are hoping this is just a pullback and we have to test more sideways, like this, or further below the average price. So weak buy above 50, I would wait to see if we break strongly above it and then buy higher. Weak sell below 45, I would not short. If I was short, I'd get out above 50. I think it's slightly better than 50-50 chance. This is not going to be a resumption bull trend. I think better than 50-50 chance, even if it triggers, will form a double top or a lower high, will come down, at least down to this area, 60-minute moving average, before the end of the day. Can you sell below 51? If the market is going up and you get a bear bar near the moving average, I always pay attention to the close of the bar. If the close of the bar is at or below the moving average and near the low of the bar, I'm more willing to take the short. Here we have the close of the bar below the midpoint of the bar, good, but it closed above the moving average. And therefore, I would not short below 51. I would wait to see if we get a strong bear breakout and then sell. Whenever you have a breakout in a channel, 75% of the time, you're going to get a breakout below the channel. 25% of the time, you'll get a breakout above the channel, and it becomes a stronger bull trend. I'm going to open a PowerPoint. A bull breakout, strong bull trend. And here we have a bull channel. 75% chance you're going to get a successful break below the bull channel and a conversion into a trading range. 25% chance you'll get an acceleration up and another stronger bull trend. Breakout channel. So strong bull trend, weaker bull trend, and then trading range. Strong bull trend, a breakout, a channel, weaker bull trend, and then a break below the bull trend line, the bottom of the trading range. Breakout channel, and then break below, and then trading range here is a bear trend. Tight trading range, computers are doing the opposite. So they see a buy signal above 47, they sell it. They see a pullback in a bear trend at 49, so a bear trend, a pullback, they buy it. And they're scalping. They may only be scalping for 1 tick, 1 point, 2 points. But the only way to do it is if you're scalping for a small amount. And you cannot do that profitably. So you should not be looking for 1 point or 2 point scalps. The minimum scalp is about the size of an average bar, maybe slightly less. And today, that means the scalp is 5 points. So any trade you take, only take it if you're planning on making at least 5 points. Breakout, pullback channel. Market often comes down to the start of the channel. So this area, it's below the 60-minute moving average, but we do not have a very good sell signal bar yet. We still have a magnet. Yesterday's high is always important. The most important resistance on any chart is the high of the prior bar. The most important support on any chart is the low of the prior bar. On a daily chart, yesterday is the prior bar. So its high is resistance, important magnet. Its low is an important magnet as well, important support. Yesterday's low is last week. Yesterday's low is also the low of last week. So it's a magnet on the weekly chart. The high from a couple of days ago is the high of last week. So on the weekly chart, that is the high of the prior bar, and this is the low of the prior bar. Both are magnets. 52 closed below the moving average, good for the bears, but not a big bear bar closing near its low. And it did not even close below the low of the prior bar, 51. The bears are trying to get a breakout bar here, and then a measure move down. Remember I said that I thought by the end of the day, we'll come either down here or here. You know, it could go a lot lower. I think we're going to come somewhere in this area. We may have to go up and get a double top or a higher high. But this bull trend is not strong enough to last all day. You know, we had 2 body gaps that closed. We have a lot of sideways trading. We had big move up, big move down, big move up, big move down, big move up. So a lot of reversals, trading range behavior. So I expect we'll get more trading range behavior, which means we go up for a while, we go down for a while. So I think we'll get down to the 60-minute moving average and the 36 low at a minimum, the market's deciding if that has begun here or if we have to test up here first. We don't know. Now, I said I would not buy above 50 because I felt like the market did not adequately test the moving average. We did not dip far enough below it after 3 bear bars. What about buying about 53? It's a tight bear channel, only one small pullback. For the bulls to buy about 53, they want as big a bull bar as they can get. And just like I said, the bears needed a close below the moving average. The bulls will need a close above the moving average. So, for most bulls to think about buying about 53, they'll want 53 to be a big bull bar, closing near its high and closing above the moving average. Since this bear channel is tight, a lot of bulls will not buy above 53. They'll wait to see if we go sideways more and then go up, or they'll wait to see if we start to get 2 or 3 bull bars and then buy. So not very bullish, not very bearish. The highest probability event remaining in the day is a pullback to the 60-minute moving average and this low. It may have begun here, or we may have to go up and then here. So if we go up and lower high and then down, head and shoulders top, left shoulder, head, right shoulder. When you have a reversal from a wedge rally, you're usually going to get 2 legs down. And the pullback after the first leg down typically is the right shoulder of a head and shoulders top. And the second leg up of the wedge is the left shoulder. I'm going to turn the screen off and open a PowerPoint. Everybody's waiting to see if 53 will be bullish enough to buy above its high, and the answer is no. It's not going to be a big bull bar closing near its high and above the moving average. So I would not buy above 53. Stop order, bears made money. Wedge top, bear bar closing near its low. If they sold 1 tick below, it had to fall 22 ticks below 45 for them to make 20 ticks, and it did. So part of the reason for that tail 53 is bears scalping out with 5 points. Doesn't look like a wedge, but 3 legs, 3 reversals down, and you expect at least 2 legs sideways to down. So first leg pullback. The pullback often is the right shoulder of a head and shoulders top. 1, 2, 3. The second leg up on the wedge is then the left shoulder. So a reversal from a wedge top is often also a head and shoulders top. Small version of it. So 3 reversals down, 1, 2, 3, and 2 legs down, 1 pullback, 2. Similar to today, the first leg down, not bearish enough for many traders to sell. We got an attempt at resumption of the bull trend, but it formed a lower high. It's also a lower high major trend reversal, in addition to a head and shoulders top. Every head and shoulders top sell signal is also a lower high major trend reversal. So far, good buying on the part of the bulls. Bears are giving up in a panic, but will the bulls buy in a sustained way to break far above the high of the day? I don't think so. I think if we get up to the high of the day, maybe we'll get up to yesterday's high, but I doubt we're going to go a lot higher. Too much bearishness. The bears are strong here and here and here. And that usually will prevent the bulls from being able to create a big bull trend day. bears giving up, so reasonable to exit shorts. Is it reasonable to buy? Some bulls would buy above 53. If 53 closed at or above the moving average, I would have bought. But for me, it's just not bullish enough. Let's say we keep going up. At some point, I'll have to buy. But one bull bar, not enough. I'll wait to see if we get a couple bull bars. And even then, I may wait until we break above 45, because most likely we're not going to break far above 45, so there's probably not a lot left from this rally. 60% chance we're going to fail either below here or a little bit above. So either a higher high double top or head and shoulders top. Traders know that, so a lot of bears will scalp out on this rally, and a lot of bulls will look to sell. Stop order bulls, you need the market to go 22 ticks above 53. So a lot of bulls will have limit orders to sell about 22 ticks above 53. The bears know that, so a lot of bears will place limit orders to sell around 20 or 22 ticks above 53. If enough bulls sell out of longs and enough bears sell into shorts, we'll get a lower high major trend reversal, a head and shoulders top. But you need more than just the market stalling up here. The bears want a good sell signal bar. Not a great bar for the bulls. The bulls did not buy into the close of the bar, so they're not confident the market's going to go a lot higher. For the bears, okay to be out of shorts. It's also okay to stay short and sell more at the 45 high. You could get out above 45, and if we get a reversal, you could sell again, or you could sell more at the 45 high, betting you will not go much above 45. But that's something only experienced traders can do. Right now, most traders' best choice is flat. Some will be long above 53, but I would scalp out unless we break strongly above. If you do scalp out and we accelerate up, you could buy more higher. But the odds are against that. Maybe 20% chance that we're going to suddenly accelerate up and break far above the wedge. Okay, I apologize for my voice, my babysitting voice, my laryngitis. Babysitting too much. And Brad is going to take over. If you have a good day.
Hey everybody, give me 1 second here. I want to turn on the pointer and fix the audio. So overall in the day, a couple things. One, tight trading range on the daily chart, and we're right near the 6,000 round number. We came really close to it. Back over here, I think came within 14 or 15 points, and we sold off. And I made the comment that I thought we'd have to go above 6,000. And I think the market's going to get above 6,000 right here. 5-minute chart on the open, and we had a consecutive buy climaxes going into the close of Friday, and then we sold off on down to right here. Bar 1, we formed a really big bull bar closing on its high today. Whenever you see those kind of bars, a really big bull bar closing on its high with the open being near the low of the bar, especially in a fairly neutral environment. Look where the moving average is at the close of bar 1. It's right at the moving average is right at the close. So really not a good area for traders to buy. And then bar 2 is a rather weak looking bull bar. And because of that, it's not a strong follow through bar. There's a lack of urgency for traders to buy. And what that means is there's increased risk that we fall below the 1 low. Bulls, they should have gotten a second leg up after bar 1 and 2. They failed. And instead we broke to the downside. And when the market broke to the downside on bar 4, the odds were we were going to fall below 1. And they got followed through 4 and 5. I thought there was potential for a measured move. But whenever you get a sell-off on the open, especially with buying pressure, bar 1 and 2, there's added risk that you test all the way back to the 1 close. And that's what happened over here. But now big down, big up, big confusion, trading range. we had a rally, there was increased risk that we form some kind of higher low. And you can see we formed basically a spike, and we've been channeling up ever since. I'll mention that the bears, they want a lower high major trend reversal, which is reasonable. We're still in a tight trading range, and that damages the argument for the bears. As far as selling below 55, it's selling fairly low in the range. So selling below 54 is really not a high probability buy. Therefore, probably buyers below it. You have traders who are long on the buy above 53, hoping that we'd rally up to a new high. Not a great entry bar 54, a little bit too big, and then weak follow through 55. Looks like more of a leg in the trading range. We're still in the bull channel, and therefore we still may go higher, but we're getting a lot of overlap, and all that overlap damages the argument for the bulls, even though it's slightly more bullish than bearish. 15-minute chart. We have a high one buy, breakout, pullback, buy signal, but we have 3 legs up. 1, 2, 3. That increases the risk of sellers above, and we fall below the signal bar, and therefore we may end up falling below the bottom of the 3rd leg. So on the 15-minute chart, my concern is that there might be more sellers up here than buyers. Now, if you're selling above a high one on the 15-minute chart that I just pointed out, the prior bar, what's the chances that you could go above the high of the day and the bears still make money? Well, the chances are real. We could easily go above the 44 high and still allow the bears to make money. The bulls are hopeful that the rally is tight, which would increase the chances of some kind of measured move. So even though we have most of the bars above the moving average, and you can argue it's more bullish than bearish, it's really not all that great. And there's probably sellers near the high of 44. What do you think is going to happen to the bulls who bought above 54, 53, the stop entry? What do you think happens if they put their stop at break even? They buy 53, they get 2 consecutive bull bars, and they move their stop to break even, thinking, yeah, I'll just move my stop to break even. That way I can take partial profits on the winner and break even on the losers. Well, I think you know what I'm implying. The breakout point, 55 high, is probably going to close. Why? Because we're in a trading range. And that's what happens when the market is in a trading range. It's in a trading range. I think we're going to fall below the 55 low. And the reason, well, looks like it's happening. The reason is what I mentioned on the 15-minute chart. It's a bad high one late in a channel. And that increases the odds that we're going to pull back. Can we still get above the 54 high? Sure. And so far, we don't have a great stop entry sell below 56. Bulls who bought above 55, stop below 55. They're still on the swing buy. But I have to say, I think they'll probably end up getting stopped out if they have a stop below the 55 low. This does not seem like all that great of a market for the bulls to be holding on the longs in swing trading. Bears, they're still on the swing short from 45. They're hoping that 55 is a lower high. But the problem with it is it's too low in the range. Right at the moving average, and the moving average is flat, and therefore low probability for both the bulls and the bears. 60-minute chart, fairly weak rally today. Big bull bar with a tail, doji, bull bar, but a close below the prior bar. Smaller body, close below the prior bar, and an inside bar. That looks like a leg, that looks like a rally with weakening momentum. And therefore, that makes me think that we're probably going to pull back fairly soon. Low of the current hour is 3, and the low of the prior hour is 36. Therefore, we may end up falling below the low of the current hour, the 36 low. Many ways to draw this wedge. 1, 2, 3. You can argue failed breakout of the bull channel, 3 pushes. Probably going to pull back. And even if we go above 45, I think there's probably sellers above it. I'll take a look at Discord. So feel free. I've got Discord pulled up, so feel free to ask questions for those that have them. Not a great stop and trade sell below 56, and therefore traders buying it. A great stop and trade sell below 56, and therefore traders buying it. Again, we still may go above the 44 high. But if we do, there's probably sellers not far above it. Bulls. The bulls need to trap the bears and prevent the bears from getting. The bulls need to trap the bears by getting a strong breakout with follow through. But as of right now, I suspect the upside is probably limited, and there's probably sellers somewhere up here. Bulls getting a good breakout, trying to trap the bears. A little bit of a surprise, 57, 58. So let's see how 58 closes. You know, buying right here at the market, really ever buying a new high of the day or new high in the rally. Since over here, so far buying a new high has led to pullbacks. And therefore, this makes me think we're probably going to lead to get a pullback as well. Probably going to lead to get a pullback as well. But enough momentum that we may get a small second leg up. Always in long, yes, but late in the bull channel. And that is a problem for the bulls. The bulls, they really need to get this bar to close on its high. And right now, it's still stalling. And that stalling is profit-taking bulls and bears selling, betting that this rally, that this is a brief opportunity to sell at a better price. The bulls need this bar to rally and close on its high, because that would further trap the bears who sold the 45 high. But if we start to stall for too long at the 45 high, then the odds are we'll reverse back down. Remember what I said over here? I made the comment that bears who sold the high won, and we could easily go above the high, and those bears still make money. This is what I'm talking about. We could still easily break to a new high of the day, find sellers, and reverse back down. That's the concern that the bulls have right here. Bulls are hoping this is a successful bull breakout of the bull channel. And the more this bar closes on its high, the more likely we're going to go higher. That would take you all the way. A spike in channel would take you all the way up here. And you can see more and more bears are now giving up. So it looks like we're going to get some kind of second leg. Now, why do traders, if you think about it, is this an easy area to buy? Well, not really. It's actually a little bit challenging. You have a channel and you're late in the channel. Yes, you can argue it's a successful measuring gap and that the market's going to get some kind of measured move all the way up here. That's certainly an argument. But one of the problems is risk. So you're buying late in a bull channel. Okay, that's a problem for the bulls. We just went to a new high and now we're pulling back. So look at that. Does that look like the start of a measuring gap and a strong bull trend? Or does this look like exhaustion? To me, this looks like exhaustion, and this makes me think that if we go sideways, we might find sellers up here and reverse down. One of the problems is every pullback you get in a channel, every pullback is a reversal attempt that fails and gets trend resumption. And eventually, if you keep getting pullbacks, it's going to increase the odds. It's going to increase the odds, one moment, of a reversal. So while yes, the bulls, they're doing a good job right now, that tail above is a problem. Bulls will see the pullback, the close as a pullback. But how many bulls are going to be willing to buy on a stop one tick above the 58 high? That is the problem that the bulls face. This breakout is a little extreme. And if you're buying, bottom of the breakout's already down here. And I don't know if there's a 60% chance we're going to get a measure move up of the range of the breakout before we pull back. It can be frustrating to see a rally and miss it. You see something going up and you're missing it. But you always have to weigh the risk relative to the reward and the probability. How much are you willing to risk for an outcome or a reward? You can always use a tight stop below a prior bar, and that's what I suspect traders are doing here, traders that are buying. Obviously, the momentum is increasing, and that is good for the bulls, and that makes me think the first reversal down is going to be minor. And that is good for the bulls, and that makes me think the first reversal down is going to be minor. There's other traders who will wait for a pullback or a pause and then look to buy. The traders who will wait for a pullback or a pause and then look to buy. But again, tail 57, tail 58, probably going to have a tail 59. When you look at this chart, spike, channel, bull breakout, obviously that bull breakout is a surprise. And surprises often get second legs. We have 7 minutes left in the bar, and this bar is already really big. The open of the bar is the low of the bar, so it's climactic. And climactic bars usually often pull back. So what's the chances that the next 15 minutes is going to go straight up without pulling back? I think it's pretty low. And therefore, I suspect we're probably not going to go a lot higher without pulling back first. That is the concern that bulls have right here. And that's partially why I'm not interested in buying. My concern is the risk relative to the reward. More profit taking by the bulls and bears beginning to sell. And the bears who sold the 45 high and more higher during 58 and 59, are they going to make money? I suspect they probably will. We have a bull breakout late and bull channel. Chances are those bears who sold the 45 high and more higher are going to be forgiven. So if you're a bear and you sold here and you scaled in higher, such as the prior day's high on Friday, you're probably going to make money. A close above the 58 high, that's good for the bulls. I'm going to check something. However, and we barely closed above the midpoint of the bar, that's also good for the bulls. They're a pretty big tail above the bar. Makes me think we're probably going to pull back soon. This bar is important. It determines the close of the 15-minute chart. But even if the 15-minute bar closes near its high, this rally has a lot of overlap, and that damages the probability for the bulls. Good for the bulls. An inside bar, so a high one buy. However, a micro channel, 57, 58, 59, 60. One of the important things is when you look at a rally and it's not quite strong enough to buy, or you'd rather wait for a pullback, that doesn't mean you should just look to sell. Good rally, yes. Strong enough rally, second leg up likely, yes. But I still think we're probably going to get a pullback. So what's the chances that we continue to go all the way up here without pulling back? That'd be a low probability event. And therefore, high probability event would be a pullback. It's easy to be fearful of missing something. But the reality is, if it doesn't look quite right, who cares? My biggest problem right here with this rally is the risk. Bull breakout late in a bull channel. Breakout is strong. Just look at the 15-minute chart. What's the chances that the current 15-minute bar is going to be the same size as the prior? I think the odds are against it. And because of that, this makes me think the odds are we're going to pull back. So for me, again, I'm just not willing to buy this far from the moving average. When I think the risk is real that we get back to the breakout point, the 44 high. I'll remove this line, put it back down there. Not a strong reversal bar, but a bear bar. 6th bar bull micro channel, but a micro double top, rally 59, pullback, rally 61, pullback. I think it's okay for always in bears, bulls to get out below the prior bar. There's probably buyers below, but we have magnets below the 44 high, 45 high, tails above 58, tails above 59. The risk is real that we end up getting a reversal here, and that's what the bears are hoping for. Not yet high probability. You can see a 15-minute chart with the market reversing down. It's trying to form a bear bar, but again, not yet high probability. Bears trying to get the reversal down, but they're not getting strong follow-through bar. Next, if they're not going to get a strong follow-through bar, what do the bears need? The bears need to prevent the bulls from getting a strong high one bar. So some bulls, they'll get out below 61 and they'll look to buy again above 62. Weak high one buy, 62, so sellers above. We still may get to the breakout point, 45 high. High one buy, 62, sellers above, but most high ones lead to pullbacks. Again, the biggest problem that the bulls have, that the bears have, is the breakout up to 60, 59 is still fairly strong. Bears need to create more selling pressure. So the bears are hopeful that they can make the market go sideways here and create more and more selling pressure and cause a reversal down. Bulls trying to get follow through on the high one buy. Still always in long, but the risk is big, and that will limit the amount of traders willing to use a wide stop and scale in lower. My concern is we end up going sideways here. Minimum follow through, 15-minute chart, bull bar, but a close under the prior high. And that slightly lowers the probability for the bulls, increases the risk of a pullback. Whenever you're confused or you cannot structure a credible trade, it's often better just to wait and do nothing. Yeah, that's one of the reasons why traders struggle so much. Is, aside from not knowing what to do, a lot of times traders are too aggressive. And what that ends up causing is a lot of bad trades. They have good trades, but then they mix in a lot of stupid trades. Stupid trades are trades with bad risk reward and low, and let me say it differently. Bad trades or dumb trades are trades with poor traders' equations. So where you have a bad risk reward, such as a big risk and a reward the same as the risk on a fairly low probability trade, that's an example of a dumb trade. There's not a mathematical basis behind the trade to support it. You don't have a statistical edge. There's nothing wrong with buying above 62. The question is, where do you put your stop? And how much are you willing to risk relative to the profit potential? For me, I'd rather wait for the pullback. Another bear bar, 64, making it difficult for the bulls to stay long. Again, I still think this rally is a little bit dangerous. It's starting to go sideways, and that increases the risk of a pullback. We also have the breakout point right here. The breakout point of the 45 high. And I think the market is probably going to get closer to it. Someone said that I mentioned poor risk reward ratio for the trade expecting a second leg if the market's always in long. Would the probability be high? Since the probability is high, wouldn't it be worth taking the trade? And they're saying this from Al's always in long video. Yeah, so basically what they're saying is, if it's always in long here and you put a stop down here, isn't that enough of a reason to take the trade expecting a second leg? Sure. This is different than this. So the rally to bar 11 and 12 was stronger than this, and it came earlier in the move. The problem I have with 60 is it's later in the leg. Now, again, there is still the argument that this is a measuring gap. And that's what the bulls are hoping for. Bulls want a measuring gap from the 25 low to the 45 high, projecting up. And they might get it. But right now, my thought is the gap, the 45 high and the 62 low, is fairly big. And I think the gap's probably going to get more narrow. So I'm not convinced that we're going to go straight up without pulling back first. And therefore, my problem with this trade is this. If you buy anywhere in here, you put a stop down here, 1 times the risk is all the way up here. And I'm not yet convinced that that is going to get hit. So I'm not convinced there's a 60% chance we're going here before we pull back. Again, I still think the odds are against the market going straight up. Now, one thing that's going on here is we're going sideways, and that's dragging the moving average up to the current price. And that's good for the bulls. Bulls have an implied second entry. They had a second entry sell. The bears had a second entry sell, 64, and the market went outside up 65. And the bulls are trying to trap the bears with 66. Going outside up 65. And the bulls are trying to trap the bears with 66. Now, what happens for the bulls if 66 is a bear bar closing on its low? I think the bulls probably have to get out. Someone asked, why am I using the 25 low as the start of as the measuring gap? Well, yeah, so what I'm basically showing is we had a spike and channels are the start of a trading range. Here, it's possible that instead of starting the trading range, the market cycle reset. And we got a bull break out of the trading range, which would mean we would get a measured move up. The measured move could be the 36 low to the 45 high. I'm just starting with this point over here. I think more likely we're going to test down to this breakout point here, the green line. Obviously, we don't have to. lots of hesitation with 66, increasing the chances that the market pulls back. And that is the concern I have for the bulls. Pullback could simply mean the 62 low. But again, as I mentioned earlier, part of my problem is how big this gap is. 44 high, 45 high, 63 low. How big this gap is. 44 high, 45 high, 63 low. Good bar for the bulls, 66. We're always in long, and therefore you will have bulls putting a stop below. You will have bulls putting a stop below the 65 low. The 65 low. Consecutive bull bars. So we have a breakout and follow through, 65, 66. Strong enough breakout for a second leg. What do you notice right here? Look at the distance from the current price to the moving average. The distance is far, and that increases that increases the chances that the market will pull back. But it is still always in long and okay to be long. Bulls, I think the bulls that are buying are using a tighter stop, either below the 62 low or the 65 low. Do we have to stop and do we have to pull back? Of course not. Do we have to stop and do we have to pull back? Of course not. We can certainly keep going higher. Now, one of the things, we had a rally and we went sideways for several bars, and therefore that pulled the moving average closer to the current price and relieved some of the exhaustion by the bulls. We may end up getting up to the leg 1 equals leg 2 target here, pull back here, and a possible measuring gap, the low from here all the way up here. And if you miss the whole thing, who cares? These are a bull break out of the bull channel in general is a low probability event. And therefore, I'm perfectly fine with missing it. Now, where would a bull put a stop if they're long? They probably put it below 65. But tail 66, tail 67. It's still buying high in the range. Nothing worth selling yet. Most bears that did sell below 61 or 64 probably get out above 65, the outside up bar. And for the bulls, if we get a bear bar closing on its low, 68, I think it's worth the bulls getting out. Far from the moving average, all the way down here. That's the concern that the bulls have. Because of the 3 consecutive bull bars, it weakens the probability for the bulls. Excuse me, it damages the probability for the bulls. It damages the probability for the bulls. What are the chances we get all the way down to the 56 low? That is fairly low probability. So even if we do pull back here, I suspect buyers below. What would you like to see to think we'll go to the bottom of the channel? Well, part of the problem here, you could argue the bottom of the channel is right here. There's the bottom of the channel, maybe the top of the channel right there. But we're breaking above the top of the channel a lot. And therefore, as far as going down here, I think that's less important right now. me, this is getting strong. Those of you in Discord can just released the calendar for June, and there's going to be the start of the new Euro DAX session subscription. So if you want to look at that calendar, you can see both the regular Emini calendar as far as who's talking what days, as well as the Euro and DAX. We had a bull breakout, 66, 67, bad follow through 68, and looks like we're getting disappointment, 69. The bears, they need to start collecting bear bars closing on their lows. That would increase the chances that we're going to pull back. Again, if you want to ask questions, feel free to type them in Discord, and I'll see about turning on. I also turned on the question box in GoToWebinar, so feel free to ask questions there as well. Bear bar, 69. Okay to get out of longs below the bar. And wait and see what we get. But a lot of overlap. Always in bulls, trying to prevent 69 from triggering, but I suspect it probably will. And there's the risk that you may have bulls exiting below the 69 low, and we may get a couple of legs sideways to down. Someone asked a question about studying Al's price action and being consistent. And I think one of the most important things, two things. One, for me, I spent a lot of time watching Al's material and really on simulated. Now, this was also way back when. So I'm trying to think of the best way, how I want to answer this in the most constructive way. So let me think about it like this. What would somebody do if they just got Al's course? Well, the first thing you need to do is you got to actually take the time to watch the course. And so what I would tell everybody is first, watch the course. And however long it takes. Give me 1 second here. Once you watch the course, the next thing you got to do is really got to think about the key concepts, and therefore then go through the course again and take lots of detailed notes. And then as far as trading, how would I go about that? I would focus on one particular thing, such as breakouts and second legs. And I'd get really good at identifying a breakout. I'd learn how to quantify. What is a breakout? How do you identify a breakout? What's a strong breakout? What's a weak breakout? I'd find a way to count legs. It doesn't have to be implied, but even a simple leg count where you have, something like this, where when you have a micro channel down, that's all leg one, even though realistically, a discretionary trader, they're going to see it as a parabolic sell-off, and therefore it's really leg three. But I would learn to think about it like that. And then I'd really spend a lot of time figuring out, what is some sort of thinking about breakouts. What environments are breakouts most profitable in? What's the average depth of a pullback when you get a breakout? And then, so I break it up into pieces. One of the reasons why I think traders screw up so much is they try and do way too much, and they try and trade from bar one all the way to the end of the day, and they just say, well, I'm just going to keep trading every single bar, and I'll just adjust my trading depending on what the market's doing. And that's really not what you want to do, especially when you're starting out. So for most traders, I'd keep it simple. Even consider something like a 3-bar bull micro channel. And the other thing is I'd have a realistic expectation as to how long it's really going to take. If you're interested in trading and you're hoping to figure it all out in a year, I think you're going to have you're going to be disappointed because it's going to take longer than a year. Still targets above. So it looks like we're not going to get the pullback. So it looks like we're not going to get the pullback. Okay, question. Starting at bar 7 down here. How many legs up do we have at this point? So from here, how many legs up? We had 3 legs. 1, 2, 3. And then we got a bull breakout of the wedge. And now we're trying to get, you can argue, 1, 2, 3. So the bulls reset the leg count. 60-minute chart. Bulls getting follow through after the prior hour. Target the high of the, looks like 29th. The high of the 29th. That is a magnet for the bulls. Again, one of the dangers of just because you think it might be exhaustion, it's very dangerous to sell it because it could go a lot further. I think we're so close to the leg 1, leg 2 magnet. We're probably going to get there. Sell it because it could go a lot further. I think we're so close to the leg 1, leg 2 magnet. We're probably going to get there. It looks like we're on the start of we're starting the rally up to 6,000. It's only about 50 points away. And if today's a bull bar closing on its high, that might give tomorrow enough momentum to reach 6,000. Tail 71, but tight bull channel. Most traders are probably better off at this point waiting for tomorrow. By bar 72, usually whatever rally you have is not going to last until the end of the day. Plus, and so that's for one. Give me one. So let me get a sip of water. So bar 71, strong enough rally, but bar 72, the current bar, is kind of the cutoff point. It's really easy after bar 72 to get a reversal. And so for me, I'm not willing to buy anywhere up here after bar 72. This rally has gone on since bar 56, and we're probably due for a pullback. So I suspect we're going to pull back before we go a lot higher. So we're really, time's working against the bulls. Not really there's not enough time left in the day for the bulls to do much of anything here. Or for traders to be flat and waiting. And if you missed all of this, don't worry about it. It was a fairly low probability event. Low probability without a pullback. Certainly impressive buying though by the bulls. And that increases the chances that there's buyers below and we'll get some kind of second leg. But buyers below on a 60-minute chart could be a relatively deep pullback on the 5-minute chart. Climactic bar 71, and therefore the market found sellers on the close of 71. Consecutive bear bar 72, 73, probably sellers above and sideways. So as far as the market going a lot higher, I suspect the upside is probably limited. We're so close to the moving average, we're probably going to get there, and there's really not enough time left in the day. I suspect there's probably sellers above 74, and that is assuming 74 is not a strong bull bar closing on its high. Even if it is a bull bar closing on its high, I still think probably sellers above. Minimum follow through for the bears, 74, so probably going at least a little bit lower. How far down can we go? Start of the channel after the breakout 70, after the breakout 59 is the 62 low, so we may get there. Minimum target, which we're already at, the 70 low. Bottom of the third leg up. Moving average, that's another target as well. So what happened with 57 and 58 and 59? The bulls had the breakout 58, and they got followed through 59 and 60, and that trapped the bears into a bad sell, selling above 45. And that's what led to the rally. Again, it's so late in the day that it's becoming increasingly more difficult to take trades, and therefore most traders probably better off waiting for tomorrow. Question: Al's work seems to use a lot of discretion and context. Is there a mechanical setup based on his work you would suggest? Well, the interesting thing about mechanical setups or mechanical trading methods, let's take a few different examples. Give me just 1 second here. Anyways, back to what I was saying. Let's take the example of the exact opposite of fully discretionary system. And let's talk about a fully automated system. I know people that have built fully automated systems before with moving averages and various breakouts. And what I've seen is the profit factor is about a really good automated system is about 2. Now, with all of that, as far as taking Al's methodology and how do you throw it into some sort of mechanical based system, I think the easiest one is breakouts. And what that would require is a few things. You'd have to be able to identify trend and trading range behavior. You'd have to identify the leg count, and then you'd have to quantify and identify what is the type of breakout you want to trade. What are the strength factors? And is it weak? Is it strong? Is it a micro channel? You would have to quantify those things. If you could quantify all of those pieces, then you could have a mechanical method. A discretionary system, assuming that a discretionary system that's profitable, something like Al, or something where you're allowing yourself to trade various market cycles, is always going to outperform a semi-automated or a rule-based system where you're trading breakouts and second legs and you're not trading the third leg, and you have to have specific rules. The discretionary system is always going to be harder to build, but it's more profitable. But as far as how do you, is there a mechanical setup? The problem with that logic is leg counting. It's not that hard to build a profitable trading strategy or trading system based on Al's material. Now, the hard part is, if you really think about constructing it, it's not that difficult. You would need a breakout, and don't trade the third leg in a trading range. So if you just trade breakouts and second legs, buy and scale in, and don't trade the third leg, you're probably going to make money. Now, here's the hard part: leg counting. How do you identify what's a third leg, and how do you define what a reset is? Like this right here. Is this a third leg up, or is this a reset? What leg is this? What leg is this? What leg is this? Here. Is this leg 1, or is this leg 2, or is it a parabolic wedge? Those are all definitions you would have to define in your trading. That's what makes trading difficult. In a minute, I'm going to talk about what I would do as far as getting started. So if this is your first time joining the trading room, or if this is your first day with the Brooks trading course, what would I do? Outside up 76. Good for the bears. Probably going to pull back to the 62 low. First thing I would do if I was getting started with trading is finish the video course of Al's. So you take the Brooks trading course, and I would finish it. There's several of you who have the course, and it's probably been a year or it's been 6 months and you have yet to finish it. That's the very first thing I would do. Because the reality is, to keep it kind of blunt, if you can't finish a 100-hour video course, you probably don't have the patience to figure out trading. And for some of you, it may seem like that's too much information, or it's just too much to study. Well, that's really the requirement of what it takes to figure it out. Now, you can learn it all in pieces, But that is the first thing I would do. And you take it one video at a time, one bite-sized piece of information at a time. Again, I think we're going to be mostly sideways for the rest of the day. So for me, I'm not all that interested in doing anything here. All right, let's get the review started. Daily chart, bulls forming a strong bull bar closing on its high. And that's good for the bulls. It increases the probability that the bulls are going to get a second leg up and get up to the 6,000 round number, which is what I've been expecting over the past couple of weeks, really ever since over here. I thought we would reach it. And then when we had this deep pullback, I thought the odds were high that we'd get a second leg up. 5-minute chart. Coming into today, yesterday, let me do it like this. Yesterday, we rallied, or last Friday, we rallied into the close. There we go. So last Friday, we rallied into the close. And today, we gapped down below 81. On the open, because of last Friday's bar 80, the odds were reasonable that if we went sideways, we'd rally up to the high of this buy signal bar. And that was resistance. Bar 1 today, it's a big bull bar. And generally, when you get a big bull bar, it's a low probability buy. And that increases the odds that the market is probably going to pull back fairly soon. 2, bull bar, follow through for the bulls, but a smaller bar relative to 1, probably not going that much higher without at least pulling back first. And then 3, bear bar, but a bad high 1 buy, probably buyers below 3. And instead we got a surprise on 4. 4, strong enough bar, probably going to go at least a little bit lower, probably going to fall below the 1 low. Bears, they're hopeful that we get follow through after 4, closing on its low, trapping the bulls into a bad buy. 5, bear breakout, closing below 1, good for the bears, strong enough breakout, probably going to go at least a little bit lower. However, part of the problem that the bulls have right here is that the tail, part of the problem that the bears have is the tail below the bar. And this tail increases the chances that there might be buyers below scaling and lower. 6, follow through for the bears, probably going lower. And then 7, bear breakout, closing on its low. 7's an implied second leg after bar 4 and 5. And we have the magnet of the open of the day and the 1 low right above. And therefore, bulls who bought below 1, willing to scale and lower, probably going to make money. And therefore, my suspicion is we're probably going back up here later today. Good reversal bar for the bulls, strong enough bar, probably going to get at least a small second leg up. And then we have an inside bar on 9, bad low 1, probably buyers below. And then 10, you can see 10, we rallied pretty much to the low of 1 in the open of the day and found sellers, but I suspect probably buyers below 10. It's a bad sell below. 11, bull breakout, good for the bulls. Bulls getting a strong reversal and increases the odds of buyers below and a little bit higher prices. Some bulls, they buy up here and they buy more lower. And therefore, we may end up getting back to the 1 close later today. Give me just 1 second here. 12, bull bar. Now we have a breakout and follow through. 11 and 12, strong enough breakout. Second leg up, likely, probably by the close. 13, more follow through. Good for the bulls. We're getting a series of bull bars up in a micro channel, and we're getting near the high of the day, the bar 2 high. Probably going to pull back fairly soon. And then a bear bar. 14, for the bears, they're hoping that it's strong enough for a second leg down. And it might be, but the reality is I suspect there's buyers not far below, even if we pull back to the breakout point, 10 high. I suspect we're not going a lot lower. 15, bull bar, not a good buy above, probably sellers above and a second leg down after 14, but probably buyers not far below 15. 16, bull bar, consecutive bull bars, good for the bulls. Still probably sellers above and a second leg down. But as far as selling above 15, I would not. There will be plenty of bulls buying above 15 and scaling and lower, especially with how strong the rally was. 17, bear bar, breakout pullback sell for the bears and a low one short after 14. The bear breakout in the outside bar, but right at the moving average, just above it. Not a good sell below the current bar and probably buyers below. 14. Instead of triggering the sell, the market rallied. Good for the bulls, probably going at least a little bit higher. And then 19, bear bar, but probably buyers below. And you can see we got follow through on 20, then outside up 21. Looks like we're going to go mostly sideways here. Bear bar 22, but probably buyers below after 21. And then we have a doji 23. We're starting to go sideways, and that's good for the bears. However, the market has not done, the bulls have not done enough here. Excuse me, the bears haven't done enough to convince traders that we're going a lot lower. 24, bear breakout, good for the bulls, probably going at least a little bit lower. And then 25, follow through consecutive bars, probably going at least, we may go at least a little bit lower, but consecutive bear bars at the bottom of a trading range, probably buyers below in a second leg up. 26, doji, probably buyers below. And then 27, bull breakout, good for the bulls, probably going at least a little bit higher. 28, follow through consecutive bull bars, good for the bulls, buyers below in a second leg up. And then 29, more follow through buying for the bulls, still buy the close and increase the odds that we're going to go higher. And then we got a doji 30, disappointing for the bulls, near above the high of the day, a little bit of an expanding triangle, so it may pull back for a couple of bars, but I suspect bulls that bought the 29 close and more lower are probably going to make money. 31, bear breakout below 30, but about high one, probably sellers above. And then instead we formed a doji. But the doji bar, not a great buy above, and therefore probably sellers above and sideways. We may have to get closer to the moving average. And we started to form a tight trading range. 36, second leg down after 31. Good for the bears, but I suspect buyers not far below, and will probably go sideways to up. Bull bar 37 for the bulls. You'll see it as two-legged pullback, bull bar closing on its high. And they're hoping that we'll get some kind of measured move after the rally up to 13. 37, bull bar, good for the bulls. 38, weak entry bar, but buyers below 37. And then 39, bear breakout for the bears. They're trying to get a break below the bull flag. And a bear bar closing on its low. However, 39 is not enough, and the bulls really need to do more than what they're doing right here. 40, bull bar closing on its high, and you can see finally the bulls got the bull breakout. For the bulls, strong enough breakout bar, probably going at least a little bit higher. But why the big bar? Why isn't this sustained buying? Why didn't it look more like this? And then look at the next bar. If this was such a strong bull bar to buy, why is the next bar weak? And that's because there's not a lot of traders eager and buying up here. Makes me think we may pull back soon. We have a bad buy signal bar, the 40 high, so we may end up testing it. Small second leg up after 41 on 43. Good for the bulls. And then follow through 44. But again, this overlap makes me concerned. And then we got a reversal down 45. For the bulls, it's a wedge, 1, 2, 3. And therefore, you'll have bears looking to sell below 45. And you'll have bulls exiting below. And that's why we started going sideways to down 46, 47, 48. 49, doji, good for the bulls. They're preventing the bears from getting a strong breakout. But I suspect the upside's limited. The channel down's tight, and we'll probably find sellers above in at least a small second leg. And we may get down to 39 low. And you can see that's what happened with 53. We got a small second leg down, but the bears are losing momentum. 53, weak, stop entry buy, so probably sellers not far above. And the market went a little bit higher, but then it started finding selling pressure. And you can see the bears reversed down on 56, but not a good sell below 56, probably buyers below. And then we got the reversal at 57. 57, top of a tight trading range. Bears, they want a lower high major trend reversal or a failed breakout above the 44 high and a higher high major trend reversal. Bulls want the bull break out of the wedge top. then we got a little bit of a surprise, 58, but tail 57, tail 58, probably at least a small second leg up. But I'm not yet convinced that the market is going to go higher, and therefore I'd rather wait and see more buying pressure. And then same thing with here. We have another tail on the bar, and therefore a little bit of a parabolic wedge, but a micro channel, probably buyers below in a second leg up. But the pullback could be really deep, and therefore I'd rather wait and see what the pullback looks like. And then we got a high one buy, getting more follow through buying, increases the odds of sellers above 60, but buyers not far below 61, 62, 63. And then we got the reversal down to 61, but probably buyers below unless the bears can get a strong reversal bar, which they failed to get on 62 and 63. 62, 63, basically a high one buy. You can call it a second entry buy if you want with 60. And we ended up forming a tight trading range. The bears, they tried to get a second entry down on 64, and then the market reversed up 65, a second entry buy, and then the market rallied for the next couple of bars, 66, 67. Then we formed a bear bar, 68. 68 bear bar. It's disappointment, increased the odds that the market's going to pull back, but not enough for the bears to start selling aggressively. The bears need to do more than just one bear bar. 69 follow through selling, good for the bears, but still not enough. And then 70, we triggered the sell below 69. However, the entry bar is rather disappointing and weak, and this makes me think that the market's probably going to pull back. This makes me think that whatever pullback we get is probably not going to go that far. And then we got a bull breakout, 71. Good for the bulls, but three buy climaxes, 1, 2, 3. So a wedge with a late buy climax, probably sellers above. And then we started going sideways at the 71 low. And then we just basically rallied into the close. For stop orders, you could buy above 1, but low probability. Buying above 2, it didn't trigger. And then I thought selling below 4 was okay, because we probably fall below 1, sell below 4, sell below 6. But if you do, you get out above, probably above 8. And then do you buy above 12? Some bulls will. I think it's certainly okay to wait and see what the pullback looks like. But if you wait for the pullback, the bears tried to get the breakout 24, 25, and they failed. So they probably buy 27. And then bulls, they buy 27. Where do they get out? A little bit tricky. Buying 27, we had a small bar 28, and then a second leg up 29, and then we pause. So some bulls will get out here, and other bulls, maybe they stay long, but really no clear stop entry sell. Even 39 is not a clear sell, and it never triggered, and that's why we reversed up on 40 and 41. I thought 45, the bear bar closing on its low, that's a good enough reason for bulls to exit, and bears, they can go short, but probably minor reversal. It's not a good sell. And then bears that sell 45, they probably get out above 53, certainly above 57. And then bulls, they're buying in here, but it's really, really tough. If they buy below, if they're long, some get out below 61, but then they probably buy again, maybe above 65. And then if they buy again above 65, they probably get out below 72 or 73. The smart ones get out on the 71 close, the bull bar closing on its high. And then that's probably it for the rest of the day. I think it's really hard to do much of anything in here. It's really easy to screw up. Limit orders, probably buyers below 2, buyers below 3, but they got trapped on 4, and that led to the sell-off. And then ideally, technically sellers above the first pullback bar and after a strong breakout, but this bad context, and therefore instead of sellers above, there were buyers below. And then buyers below 14, but sellers near the close of 13 up here. And then sellers above 20, and then buyers below 24, buyers below 15 down here for a bounce. Buyers below 30, and then I thought sellers above 32. And then I thought probably buyers below 36 down here. And then probably buyers below the 54 low, 55 low right here, but still not great. And then probably buyers below the 61 low. I thought that was okay. And then that's probably it for limit orders. Buy the close, sell the close, arguably sell the close, maybe bar 5, sell the close 6. buy the close 11, buy the close 12, even buy the close 13, but fairly late in the rally, probably going to get a pullback soon. Buy the close 27, buy the close 28 for a bounce. And, what about buying a close of 59? You make the argument, but I don't think it's that great. And that's probably it for buy or sell the close. Everything else was really enter on a pullback. Let me take a look at a couple of questions. A question, say you sold bar 45. When do you realize you're wrong and not scaling anymore? Well, selling below 45, to me, it's not a scaling trade. If I'm selling below 45 right here, I'm going to sell and I'm going to put a stop above 45. I might put a stop, a measured move up of the signal bar. So I might use a stop. Something like this initially, just to give me a little bit more time to think. But the reality is, once I start to get follow through selling going down, I'm going to move my stop up here. Why? Because I'm taking it for a swing and I really want the trade to go my way rather quickly. It's kind of like buying 57. If I buy 57, I'm going to put a stop below maybe 56. And once the market goes my way, I really don't want it to come back. And here, you're in a bull trend. You're in a spike and channel. So you're more bullish than bearish right now. And when we start to stall at the moving average and form these bull bars, 49.50, and then go sideways here, I think most traders are better off buying back their shorts. And that's what a lot of traders did on 53. 53, I would definitely get out of longs. And then 57, I think you're smart to get out of longs. If you don't get out above 57, you probably get out above the 45 high. But I'm not going to hold long above 45 and scale in all the way up. Generally, I don't like to do that. I want to trade in the direction of the always in. Question, if you were to enter the market after bar 36 over here, where would you get in? After bar 36, where would you buy? Well, you could buy 57, you could buy 60, you could buy below 60 for a second leg. For me, I wanted to see the breakout point get tested. And then other than that, I think this is all fairly difficult trading. The risk is big and it's not quite doing what you want it to do. By the time you get 3 consecutive bull bars, there's probably buyers below, so you can trade with limit order here for a second leg. But then by the time you see 71, at that point, it's too late and 3 pushes up, you're probably going to get a pullback. So that's the biggest problem I had with entering over here. But overall, it's what I said with the stop entries and limit orders, and then the buy the close, sell the close. There's plenty of trades in there, but I think they're difficult trades to manage. If you buy above 60, the high one, you probably want to buy more below 60. And then if you buy above 65, you want to be able to manage the trade properly. If you get out below 69, same thing. You want to manage the trade properly. So overall, this is a strong enough move that I think we're going to get up to 6,000, and we very well may reach it sometime tomorrow. Was bar 37 a high 2 or a high 3? Bar 37, you have to have ways to define it. And so for me, I think the easiest thing most traders should use for defining leg counting is spike breaks. In other words, don't count implied legs. So you have a sell-off, we have a break below 30 on 31, and then we have an inside bar and price went above the inside bar. That's a high 1. And then we have a sell-off, 44, 45, 46, but no price has not gone above the higher bar, the high of the prior bar, and therefore 37 went above 36, so 37 is a high 2. Or you can argue that 36 is the high 2, same place. Was buy above 37 good? Not really. It's middle of a tight trading range. So if you buy above 37, it's okay to buy above here if you're willing to buy more lower, below 36. But for me, middle of a tight trading range, from here to here, that's right in the middle. There's probably sellers above. However, if you buy and scale in, it's probably okay. Could you buy above 37 and put a stop 1 tick below 36? I really just kind of explained that. But overall, it's not something that I'd be too keen on doing. Okay, so as far as, you should see stay tuned to the Brooks Trading Course website, and you should find more information about joining the room and when the links are available. The Euro session, I believe you can sign up on Wednesday for it and just go to the Brooks Trading Course website to find more information as far as pricing and everything like that. All right. Thanks everybody for tuning in, and I'm going to I'll upload the end of day review for those of you that want to watch it again later today on the Brooks Trading Course. All right. Thanks everyone for tuning in, and hope everyone has a great rest of their day.